Hello viewers, welcome back to our YouTube channel, and today we are going to look at a new topic, and that is management of working capital. We preferred to first push this before doing some computations on ratios or financial analysis. So we are going to look at management of working capital. Management of working capital. And first of all, I want to appreciate those guys that have managed to to subscribe to our YouTube channel. And I will kindly request for those who are who have just come across to this YouTube channel that you subscribe, because we have a lot of content that is going to be coming through as long as you are in that docket of accounting and finance. It's not for only those that are still studying, but even those that want to refresh themselves and those that want to learn new things, because we are going to be having things to do with the QuickBooks, things to do with advanced Excel, things to do with financial modeling and others. So we are creating a community of accounting and finance professionals, and I urge you guys to share to your different colleagues so that they can join this amazing group where we are going to be sharing information in regards to accounting and finance. So without wasting more time, let's dive in and look at what we have to talk about today. Now, we want to talk about working capital. Management of working capital is a new topic, and it is mainly theoretical, but we have some computational things. But we want to first understand what working capital is. So definition wise, working capital, you should pardon me because I have some flu, so the voice may be a little bit weird, but bear with me for that matter. And I hope I'm a bit audible, that you can hear what we are giving out. So working capital refers to the liquid resource. Liquid resource refers to the liquid resource of an organization. The liquid resource of an organization that is used in the day-to-day operations. In the day-to-day operations of the company. That is the definition aspect. It's the liquid resource of an organization that is used in the day-to-day operations of the company, of the organization. Now, working capital comprises of two things. It comprises of current assets, and as well as current liabilities. So we have both assets, current assets and current liabilities. Those are the two main items that form up the working capital. Those are the things that we use in the day-to-day. In other words, we look at the short-term kind of things that we have in our business. Those are the current assets. They can be assets of the business, which the business owns, and there can be liabilities of the business, which are going to be those things that are going to be taking money or that are going to be demanding the organization. Those are the current liabilities. Now, when you are learning the business, you need to have money that can run the company, especially run those long-term assets that we acquired. Now, when we are doing investment appraisal or investment appraisal decision, we are trying to look at assets, long-term assets that are long-term, in nature. And we appraised them to see which one we are going to invest in. So when we invest in those long-term assets, we are using the long-term sources of finance. But now, after you have made investments, maybe worth 10 billions in assets, you have bought maybe machinery, you have bought maybe buildings that are going to be used for maybe setting up the factory and other stuffs. So you'll find that you have invested a lot of money and you have borrowed this money. Either it has come from the debt or it has come from our equity, from our shareholders. So you find that for you to operate these long-term assets that you have acquired, you need to have short-term finance, and this is going to be financed by those short-term sources, the likes of bank overdraft. You can get a bank overdraft. Maybe you have an expense to pay, you pick a bank overdraft to clear the loan. You have short-term loans. You need maybe to pay electricity, you borrow, you get a short-term loan that you are going to pay, just money to help you run the business. As you are operating these assets, there are other expenses that are going to be coming in. So those expenses are going to be financed by these short-term sources. Now, the short-term sources, they are going to help us run these long-term assets that we acquired. So we acquired these long-term investment through the investment decision. We evaluated them, but we need to have money to pay the workers their salary. We can't wait to pay the salaries of the workers maybe at the end of the useful life of the project. Maybe you are setting up a production plant and you expect maybe this production plant will start giving me money in let's say 3 years or 5 years. We can't wait to reach 5 years for you to be able to pay off salaries for the people who have been working that organization. So as you set in these long-term assets, you need people who are going to work on those long-term assets so that they can be able to yield the returns that you projected. So for you to achieve that, you need what we call working capital. and working capital is going to be the money that it's going to be the liquid resource that is going to be available. Something to be liquid is something you can easily convert into cash. Maybe you have treasury bills, you can easily convert them. Maybe you have money, you are done maybe fixed deposits and you are earning some interest. You find that that money can be received and it helps you push these expenses as they fall due. It's not that you are always going to be using your own money. At some point you are going to borrow. You may say that we don't actually have cash, but let these suppliers of ours supply us goods or the raw materials on credit that we shall pay them later. Maybe you negotiate that maybe we are going to pay them in 90 days or 60 days. So these are going to be the liabilities that are going to come in, but they are helping you to run the day-to-day operations, because if they don't give you the raw materials now, you are not going to have the final products, because it may be hard for you you may find that in a situation that for you produce, maybe your product materializes or it matures after maybe 1 week, but how are we going to be surviving? How are we going to be catering for these materials, buying materials and other stuffs when we don't actually have money because we haven't produced? So we need to get in those loans that are going to help us push these electricity bills and other aspects that we use in the business. So we may also find ourselves that we have some stock. We find it very easy that we are going to give it out on credit. We maintain some stock just to cater for the current situation. We may give it out and we expect these debtors to come pay us in some time. So we are going to be having those that we call that are going to be ours, which are assets. Then we are going to have those that are belonging to other people, which are the liabilities. So the working capital comprises of two things: the current assets and the current liabilities. And these liabilities, they are within a period of less than 12 months. So that's all about working capital. Now, let's look at the factors that are going to affect working capital levels in an organization, because we are going to be faced with a challenge of having the amount we need depending on the activities that we are going to be doing. So we look at the factors affecting working capital levels in an organization. There are very many factors that are going to affect either making us to have a low level of working capital or a higher level of working capital. In other words, this is going to show us how much working capital or how much net working capital. The net working capital, it means you have the amount, the residual amount that you have. If you are to look at the working capital that you have, how much you have at your disposal, you will be able to get the current assets minus the current liabilities. This will tell you how much you have at your disposal. In other words, if your current assets, the ones that you have that are yours, are higher than those people that are demanding you, when you get what you have minus what they are demanding you, what is left out is what we call the net working capital. The net working capital is that amount that you have at your disposal. So what the factors that we are going to be looking at, they are the ones that are going to determine whether we are going to have a higher net working capital or a lower net working capital. That's what we are basically looking at. So for you to be able to get the net working capital is the difference between current assets and current liabilities. So we need to look at the factors that are going to determine the level of the working capital that we have or that we are going to be having in the business. Number one, we have the nature of the business. The nature of the business. It's a very, very big point. Nature of the business. For example, if you are that business that is in, let's say, manufacturing business, and the other is in the trade business, these two businesses are different. The person who is in manufacturing is producing goods for sale, but the person who is in trade business doesn't manufacture, but he buys from the different manufacturers and he or she sells. In other words, this one deals in finished products alone. This one can deal in both finished goods and at the same time the work in progress, and at the same time he can also deal in raw materials. Because he is manufacturing, you may find that this business can actually sell some raw materials to other businesses, not necessarily final products. They can also be selling some work in progress because there are some unfinished products, but they can be used for other purposes. Then at the end of the day of the process, they get what we call the final products or the final goods, which are then going to be sold to these traders. The traders, they can be called the wholesalers. These are basically wholesalers. They buy in bulk numbers. They buy in a lot. But what is key here is they generally buy finished products. They don't manufacture their own products. Now, in case you are that business and you are in the manufacturing, if you are that business and you are in the manufacturing business or in the manufacturing industry, remember, in the manufacturing, it takes a lot of time to convert these raw materials into the finished goods. It will take some time. You may find that maybe for you to produce 1 bag of sugar, you need maybe to have, let's say, 2 days or 3 days. I'm just giving an assumption. If, let's say, you are manufacturing things that are going to come from the raw materials, that maybe you are producing jewelry, but maybe you're using gold or silver, but the raw materials where they get these raw materials from is a bit far. You have to wait until they bring these raw materials so that you can process the products. So it will take some time. So by taking some time, it doesn't mean that for it to take time, you are not incurring costs. You are already incurring costs in the business. So if it is going to be taking a lot of time, then it means you need a lot of working capital, because you need to have a lot of money at your disposal so that you can wait until the finished goods are produced. Because converting the raw materials into the finished goods needs a higher capital. We need to have a higher capital that we are going to invest in the raw materials, first of all, the higher capital that we are going to invest in the work in progress, and also even stocking these products, because after producing them, you have to have a separate warehouse where you are going to put the finished products, where these traders are going to pick them from. So here you need to invest more in the working capital if at all you are in the manufacturing business, so that you can be able to do your day-to-day operations. On contrary, these trade business, they normally purchase goods and sell them immediately. And these guys have even a possibility of receiving customers' money before they even get the goods. Someone can first make a deposit and they order the goods. So these guys, they don't need a lot of working capital, because what they need is to make sure that these goods are available and they sell. So what they need to have is small money that they are going to use to buy these products, the finished products. So if you are just in this trade business, you just need less working capital, because for you are going to just buy and sell, and at sometimes you may receive cash before you even give out the products. That's point number one. Point number two, the scale of operation. Scale of operations. Scale of operations. Now, there is a direct link between work in progress and the scale of operation. Scale of operation can be the size of operation. In other words, more working capital is going to be required in case you are a big organization. If you are a big organization, then you need more working capital. If you are a big organization, you need more working capital. But if you are a small organization, then you need small amount of working capital. Because at the end of the day, if you are small, it means you are employing less people. You have less people to employ. Even the creditors will not give you higher values of credits, because they know you are small. Big organization, like if let's say you look at Mukwano Industries, if you look at MTN, if you look at Standard Chartered Bank, those they need more working capital, because they have to involve in stocking raw materials, in stocking finished products, paying millions and millions of employees. Because you may be seeing an organization that has maybe 10,000 employees, but you find their agents. These agents, they earn commission even though they are not on payroll. So you find that the people they are paying, they are very many, so they need a lot of working capital. Number three is the business cycle. Business cycle. When we talk about business cycle, it's always classified into the periods of boom periods, Then we have the opposite, which is the recession period. In other words, it's like when you have ant hills. This is when there is a period of boom. Here we have boom, but here we have recession. Here there are periods where you are going to find yourself as a business, you are producing a lot of products and people are buying. The demand is high, and even what you are supplying is high. So if you are in that period of the boom, then you need more working capital. More working capital will be needed than when you are in the period of recession. Because at recession, we expect that you are not going to be receiving more customers, and thus you are not going to be incurring more costs. But at the period of boom, we expect that everything is going to be at its peak, meaning even the costs are going to be at its peak. So we are going to be incurring a lot of costs. So during the periods of boom, the demand of the product increases, and also the sales also goes up. Sales revenue increases. Even if you just look at the sales revenue alone, if you have agents, the more they sell is the more you are going to pay them. So if it is in the period of boom, it means the sales guys are going to be earning a lot of money from the business because of a higher sales volume. So you need more working capital to pay off these sales agents. Even in the business, when it is the boom, you are going to find yourself employing a lot of people. If let's say you are that kind of business and you sell maybe towards Christmas periods, you are going to find that in that period you have to make sure that you have very many casual workers who are going to help you satisfy the demand that you have. But it will not be the same, on contrary, during the periods of depression. If you don't call it recession, you call it depression. Period of depression or recession, the demand always declines, and this affects both production and also the sales. And in that sense, we also need less working capital. So as the person who is going to be managing your finance, you know when you should have a lot of money at your disposal. So that's number 3. Number 4, point number 4 is seasonal factors. Seasonal factors. When you look at maybe, if let's say you try to look at our calendar period, the calendar year, as a business, you may find that maybe towards the period of Christmas, maybe from let's say 20th to let's say 5th Jan, Christmas, New Year, and others. So you find yourself in those periods. If let's say you are selling, let's say, let's look at these people who sell Christmas trees. They get more sales in the period, in those periods of Christmas period. But if the Christmas gets off, they don't sell. If you look at the people who sell ice cream, it will be a boom period for them, if at all it's within the dry season. But if we are in the winters, don't expect people to actually buy. If we are in the rainy season, Don't expect people to buy more of ice cream. So this, by you not having customers in some seasons, it means you are going to need less working capital, because you don't want to hold too much money and you imagine you borrow the money and you keep it even when you know you are not going to be producing or selling. So if you are that business and you sell in some periods, maybe Christmas periods, maybe you're selling Christmas gifts, you find that those Christmas gifts are going to be sold more in the Christmas period. Then it means you need to look for more working capital in those periods or in that month of December, because the demand and sales, they are always high, and it's because of the seasonal or the periodic factor. And on contrary, less working capital or even no working capital in the remaining periods of the year, because who is going to buy Christmas packages when it's not Christmas period? You find yourself not even borrowing money for what? Yet you know the kind of business that you deal in. So the other, we may talk about number 5. We can look at production cycle. It's different from the business cycle. It is different. The other one is just periods of boom and periods of recession or depression. Now, this production cycle, for it only looks at the time. How long does it take? How long does it take to produce a given product? How long does it take? If it is going to take you 1 year to produce a product, in this 1 year, you're not just going to be seated. You'll be incurring other costs, even though you are not producing or even though you are not selling. The costs are going to be coming in. So if the product is going to take a lot of period, a long period, then you need more working capital. If it is going to be maybe within 1 day you can manufacture a product, then you don't need more working capital, because you will produce in 1 day, then the second day you sell. After selling, you are getting more money. There is no need for you to borrow, because remember, this short-term working capital is going to be gotten from borrowing, getting credits from maybe suppliers and others. So basically, the time taken in converting the raw materials into the finished goods matters, and the more days it takes to produce a good, the more working capital is going to be tied up. Because remember, you have bought raw materials, you are paying salaries for people, and you are taking a longer period to produce a product. So a lot of money is going to be seated within these raw materials, meaning you need more to keep running so that you can produce the goods and sell so that you can get some money back. So a lot of money is going to be tied up if at all you take a long period. It's going to be tied up in the raw materials and even the work in progress, or in the same finished goods. So by having a lot of capital tied up, it calls for more working capital, so that you can keep the production. And on contrary, when the production cycle is less or is little, then you need less working capital. Number 6, factor number 6 is we can look at the sales stroke credit policy. If you are that company and you sell on credit, you sell on credit, meaning you have debtors. If you have debtors, we need to know what is the credit policy of this company. Are these guys going to be paying in 30 days, 60 days, or they are going to be paying in 2 weeks? So the lesser the credit policy, the better. Because if these guys are going to take 90 days to pay for the goods they took on credit, you will have 90 days of not having money, because it will be tied up in these creditors, in these debtors they took and they haven't paid. So if these guys take and they come and they pay in 2 weeks, then it means you will have more money. So the lesser the credit policy, the lesser days those people take with our money, the better. And when they take lesser, then it means we shall not need more working capital. But if they are taking a longer period, 90 days, 120 days, it means you are going to borrow so that you can wait until you pay off these people. You pay them off when the other the debtors have paid you. So the more the days that you give to your debtors to collect the money for the goods that you supplied on credit, then you will need a higher working capital to keep the business moving, since more cash will be tied in those debtors or receivables. And on contrary, if the credit collection days are lesser, we will not need more cash. It means you'll find cash and run the organization, since the money would be recovered earlier. So you don't need more. The same explanation goes to the purchase credit. If you are paying these creditors, number 7 is on the purchase credit policy. It is the opposite of the other one. This one, we are paying the creditors. So the longer we take to pay the creditors, the better. Because if we take long, maybe we negotiated and we are supposed to pay 120 days. If we wait, we keep this money for 120 days, we can use it in the business to earn more money than paying. So if you are paying a longer period, then you don't need to have a lot of working capital, because you will be having money in the business. But if you have the creditors, we are supposed to pay them early in 2 weeks, then it means you will need more working capital, because these guys will take off their money. Number 8, you have operating efficiency. Operating efficiency. Operating efficiency. Now, if the company is more efficient in terms of production levels, in terms of quality, in other words, the quality being high. So if the production levels are efficient, the quality being of high, then it means we need less working capital, because the production will be higher than what the operating efficiency is. In other words, if the production things, so we shall need more working capital, especially when the operating efficiency is high, than when it's lower. Because if it is lower, then it means even the production levels are going to be lower. Number 9, we have availability of raw materials. Availability of raw materials. Now, in the periods when the raw materials are scarce, then it is going to force businesses to stock more or to store more raw materials. Because if the raw materials are scarce, it is going to automatically force the business to store a lot of raw materials so that they can use in the periods of scarcity. So they will find themselves stocking a lot of raw materials, and by stocking a lot of materials, you are tying your working capital in the raw materials that you are storing to cater for the scarcity periods. So in that case, you will be needing a lot of working capital, because you are going to have a lot of working capital tied up in those raw materials that you are storing. On contrary, during periods where raw materials are available, it makes the business to spend less on raw materials, because if the raw materials are available, you may find that you are going to even pay less money for the raw materials because they are in plain scarce. Then it means even if they are far, you have to go and look for them. By going and stressing yourself to get those raw materials, you are incurring costs. So if the raw materials are available, we are not going to need a lot of raw materials, because we can purchase as we use, because we are sure the materials are available. So we shall need less working capital. Number 10, maybe I can stop on this. Number 10, we can talk about the growth prospects. The growth prospects. Prospects of growth. Growth prospects. If you are that company that is growing daily, on a day and night you are growing, then you will need more money in working capital than when the business's growth is slow. Business growing, it means even the activities you are going to be doing are more. So there are other points you can look at, you can read from our study book or the study pack. It has a lot of those. Now, that was looking at the working capital. I was just giving you something to introduce to you what working capital is and what factors affect the level of working capital. But what is key is, how do we manage working capital? We said working capital comprises of both current assets and current liabilities. The question is, we are talking about management of working capital. When we talk about, it's very important for us to understand. We need to, because by us knowing what is within the working capital, it will enable us to know how we can manage it. But you can't manage something you don't know. So we need to understand what are the components that are making up the working capital. Sometimes the examiner calls them, these components, the examiner calls them elements of working capital, and there are only 4. So let's first understand the components or the elements. The components, stroke elements of working capital. So before we say we have current liabilities, so you need to see, is that a current asset? Is that a current liability? That's how we are going to know. Number two, and for debtors, if you have sold goods on credit, the only way we are getting debtors or receivables is when we have sold something on credit. We have sold what we produced on credit. Then you have what we call a receivable, and it's a component of working capital. Number two, we have inventory or stock. When you manufacture your goods and put those goods in the store, then you have what we call inventory. If you are a manufacturing company and you have produced your goods, when you put them in the store after manufacturing them, we call them inventory or stock. If you are a trading business and you buy or you order your consignment of goods and put it in the store, then we can say you have stock or you have inventory. For trading business, you just buy, you purchase, and you store. You wait for the customers to come and buy. So, some sales are going to be on credit, but there are those sales which are going to be on credit. In other words, the customer is going to come and pay his own money. He goes with the product. So it is either you are going to have cash at hand or you have cash at bank. Whether cash is at bank or is at hand, we just say that's cash. So when we are managing, we manage it in that perspective. The last one, number 4, we have what we call the accounts payables, or what we call the creditors, or the suppliers. Some businesses can supply goods on credit. So when you supply goods on credit, you are bringing what we call a creditor, a person who is demanding the later. By you picking these raw materials on credit, then we say that you are bringing what we call creditors or accounts payable. Now, these are the only components or elements of working capital. And when we say management of working capital, it means management of these 4 elements. But now, there is something that we need to understand from this very point. We get it from the first point, is that this number 4, them off. Because if you don't pay them, then the image of the business will go down. Because if you don't pay your suppliers on time, the suppliers who can actually supply to us raw materials, whether we have money or we don't have money. But the reliability is going to be upon your reliability on making sure that you pay those suppliers on time. Because if you pay them on time, there is no way you are going to tell them I need the stock and they don't give you the stock. That's why when they are sourcing these suppliers, they look for those suppliers who can actually supply the business, even when the business doesn't actually have cash. So under management of working capital, what we are not going to waste our time on is management of accounts receivable. So we said it's going to be through ratio analysis. And only ratios, we use only ratios. The ratios that we use liquidity ratios. These are the only ratios that we use. Liquidity ratios. We use efficiency ratios. Efficiency stock activity, stock management ratios. So, and the same way we discussed about these ratios is the same way we are going to do them here. There are two ratios that we use, liquidity ratios and then activity ratios. These are also referred to as working capital ratios. Working capital ratios. They are also called working capital ratios. So these are the only ratios that we are going to use. As long as we are managing working capital, we use only these ratios. However, if there are options or there are exemptions, if it's a manufacturing business, if it is a manufacturing company, then we add other new ratios. We add other new ratios because when we are looking at inventory ratios, the ratios we saw there, they are basically for finished products. If you specifically look at the inventory ratios, the ratios you look at under the financial ratio analysis are basically for finished goods. But if it comes to a manufacturing business, we add other ratios that are in relation to inventory maybe. So if there is a very big difference between dealing with the finished goods alone, because in a manufacturing business we have work in progress, we have finished goods, and at the same time we have raw materials. So all these, when you are looking at inventory ratio, we only looked at the finished goods, but we have also ratios that are in relation to working capital, ratios that are in relation to raw materials. So I need to add on the few. These are some of the things in relation to inventory. We looked at inventory turnover period. And this is for finished goods. It equals, we said it is the average inventory, but this is finished goods. Finished goods over cost of sales times 365 days. We put it in days, but we said it may be given in weeks, days. It may also be given in quarters. So you multiply accordingly. But for a manufacturing business, the examiner has to give you the raw material figures. You may find the question that the examiner has given you the raw material figures in the question. If he has given you the raw materials, then we are going to have what we call the raw material holding. Stroke inventory, holding inventory, days or period. And this will be the average raw materials. Average raw materials over annual purchase times 365 days. The formula changes. This is not over cost of sales. No, it is annual purchases. Purchases of what? Of raw materials. So if you have they have given in the question work in progress, this is for raw materials. This is for finished goods. But now, if at all in the question they have given you work in progress, if they have given you work in progress, because the work in progress is also as a result of a manufacturing company, then the average production or the average work in progress will be, this one is going to be the average production or work in progress will be the work in progress period will be the average work in progress over cost of sales times 365 days. Here we are talking of the sales, because work in progress can't be bought. For raw material holding or raw material inventory period, we talked about it is over annual purchase, because these we just buy them. We don't have cost of sales yet. We are just buying raw materials. But when you go to work in progress, it means the production has already started. Remember, we had other ratios. You have also to remember that we have other ratios that were on turnover. The same thing. What is going to change if it's a turnover? Because here we basically looked at the inventory days. But if it's a turnover, for example, for raw materials, remember we said the formula for a turnover, inventory turnover, is the reciprocal of n of this. As long as you don't multiply by this, you just take this cost of sales over average work in progress. You don't multiply because it is always given in times. So we say the turnover will be the reciprocal of the raw material inventory period. And we don't multiply. For example, if let's say we are looking at raw material, I just want you to understand, I gave you that only one formula, but for you can give the rest. For raw material, it's raw material turnover. Raw material turnover will be annual purchase will be the annual purchase over average raw materials. Then if it is work in progress turnover, it's also going to be the cost of sales over the average work in progress. You don't multiply by the days because it's already in ratios. Now, that's the method that we are going to use to be able to know whether we are managing our working capital well. So, let's now look at another item. We want to look at what we call the cash operating cycle. This one, they always ask it. It is called cash operating cycle or working capital cycle. It's called a cash cycle because we get the net working capital, which is current assets minus current liabilities. And if you do that, you'll be left with it. If there is something left, then it means it's supposed to be an asset. So that's why they call it a cash. But we need to look at it and see what we have in it. So the cash we need to look at what we call the cash operating cycle, or you can call it working capital cycle, or the other person can call it the cash cycle. The cash cycle, it all mean the same thing. And this is very examinable. All of them are, most of the things here, they are examinable, though they are theoretical, but this is theory in science. If you want to see, you can check question 3. Question 3, I think that's where it is. It's there. Question 3, June 2018. Question 3, June 2018. It's on this cash cycle. It's on that cash cycle. So, let's now try to analyze it. Now, this is a very sensitive area, but it is very easy to understand. So you just need to pay attention on it. It's very easy but very sensitive because it has some technical things, but it is very easy for you to understand it. And it can you can also compute it. It's computational. So that's why I'm saying you need to pay attention to it. Now, as we looked at the components of working capital, the components or the elements of working capital, you may have credit supplies. You may have credit supplies. In other words, you are receiving raw materials. We are basically looking at a manufacturing business. You are receiving raw materials. So once you are receiving raw materials on credit, you have what we call the creditors, or what we call the accounts payables. The raw materials are then going to be converted to what we call inventory. So when you convert them into inventory or stock, it means we have to now go ahead and sell the goods that we've received, since we have already done the manufacturing. We have manufactured the goods, now we have them in our store. So now we have to start calling for customers. But as we call the customers, we are going to find ourselves getting some customers who are not going to pay cash. So once they are not going to be paying us cash, others are going to come pay with cash, others will come paying later, but taking on credit. So if they are taking on credit, it means we have got what we call the receivables or the debtors. These are the people who have sold goods on credit. Now, once that is done, once you have gotten the receivables, we have to make sure that we convert these receivables into cash. We have to demand them and they give us our money, cash. So they have to give us cash. So we convert these receivables into cash by collecting the money for the goods we sold to them on credit. Now, finally, it's going to be the cash that we've gotten from our receivables and the cash sales. Remember, we sold some on cash, and the cash sales that we are going to use, these are the ones that we are going to use to pay off the credit suppliers. In other words, we are going to use the cash that we got from the receivables and the cash that we sold for the goods that we sold using cash. Either it is in the bank or we have it at hand. It's the one that we are going to use to pay off the suppliers that gave us what we call the credit purchases for the raw materials. Remember, the suppliers gave us raw materials. We are a manufacturing business. Now, let me reorganize this. The diagram, you see it, what we've been talking about. We have credit suppliers or supplies. Here we have inventory. Now, after inventory, we have the receivables or the debtors. And finally, we can show off our cash. So we connect. We said we first have the people who are going to supply us with the raw materials on credit. They have given us the raw materials on credit. These are the suppliers. So they are giving us the raw materials and we are going to produce. This is where the manufacturing takes place. We produce and we get what we call the inventory. After getting the inventory, we have to think of ways to sell this inventory that we've put in our store. And one of the ways is by selling using cash, and the other is by selling on credit. So by selling on credit, it gives rise to receivables, or what we call the debtors. When we get the debtors, after selling them goods on credit, we have to find mechanisms or policies to make sure that these debtors actually pay us in time. So we are going to collect money from the receivables to have what we call cash in the business. By us having cash from the receivables and some cash that we received on the cash sales, we shall have what we call the cash we are going to use to pay off the suppliers who gave us goods on credit. So we always don't put in this, because for cash sales, remember, cash sales, we don't manage anything. We receive the cash. Just like the suppliers, they are here, we just pay them with the cash that we got. We have to find ways of managing the inventory and also managing the receivables. And lastly, looking at how are we going to manage our cash that we've received. Are we going to pay all of it? Or we can negotiate with the suppliers and maybe we pay them half, then the other half comes in, so that we can have cash in the business, so that we don't be borrowing every time. So the whole of this process is what we call the cash. The whole of this process is what we call the cash cycle. It is called a cash cycle because we are looking at ways of getting cash. That is the end point, to pay off the other people, because that's the end point from the production. We produce to be able to have cash and have something. So this is what we call the cash cycle, or the working capital. The working capital cycle, or what you can also call the cash operating cycle. All these names mean the same thing. It can be working capital cycle. Now, the whole of the issue here is that we are looking for cash to pay off our suppliers. These are the ones who gave us the credit supplies. Now, if you don't pay off, remember we said we don't manage credit suppliers. We don't manage accounts payables. If you don't pay off the suppliers, what will happen? If you don't pay off the credit suppliers, then the company will get stuck with the production, because these guys are not going to give you raw materials, meaning you will not have inventory, you will not even have receivable, you will not have even cash, because you are going to be stuck with no production. If you don't produce, since it is a manufacturing business, you are not going to get anything. That's why we don't manage accounts payable. We pay them. So that's the very big reason as to why we don't manage payables. We just clear them off using the money that we've got from the receivables and also the money that we received from the cash sales. Because without these suppliers, then we will not have any production taking place. So, receivables, inventory, and cash we have to manage it very well, because after paying off these suppliers, what has remained is what we call the net working capital. But the cash came from these different options, but what remains from the cash that we have after settling off the suppliers or the creditors, we remain with what we call the net working capital. And the net working capital, we said, is the current assets minus current liabilities. We all know that inventory is a current asset. Creditors, sorry, the debtors are current liability, current assets. Cash is a current asset. So we add inventory plus the receivable plus the cash, and we take off the liability. What we remain with is what we call the net working capital. Remember, I said this is a computation aspect. That's why I'm deriving all these theoretical things. Don't think I'm just wasting time. Now, let's conclude. Conclusively, as we conclude, as we wind up, when we check our notes, we can conclude by looking at the definition of the cash operating cycle. Let's decide, because we need to understand what a cash operating cycle, cash operating cycle. We conclude, then we see the mathematics behind this. We said it is the same as the cash cycle of the business. So this is the average length of time, between the payment for purchased materials and the receipt of payment from the trade receivables, and the receipt of payment from receivables, or what we call the debtors. In other words, it's how long does it take from the time you purchased on credit up to the time you get the money from those whom you sold on credit. So the above definition is the definition for the net or for the cash operating cycle. But this is a practical paper, and the examiner will require you to compute the cash operating cycle. And as we have agreed from the explanation that I gave, I told you that we are going to be computing. So we need to take note, especially when the business is a manufacturing business and when it's a trading business. So the working capital cycle can be in days, it can be in weeks, it can be in months, it can be in quarters. So you have to see what the examiner is telling you in the scenario of the question. So I want us to look at the manufacturing cycle. The manufacturing cycle. So the manufacturing cycle, we start with what we call the raw material holding period or raw material inventory period. We start with the raw material holding period. We add the work in progress. I'm just going to call it WIP, work in progress holding period. Then we add finished goods holding period. Then we also add receivable collection period. Collection period. Then we less off the payables payment period. We less payables payment period. And that will give you what we call the cash cycle or the operating cycle. What we call the working capital cycle. So that's what these ones we are supposed to add them. So that will give you the, however, we need to look at if it is all about a wholesaler, if it is a trade business, not a manufacturing business. If it is a trade business, then how do we determine? For a trade business or a wholesale business or a retail business, we don't have raw materials. And we also don't have work in progress. In other words, the format will be the same, but we don't have work in progress and raw materials. So this one, it will be the inventory. Inventory, this is now the finished goods. Inventory holding period. Then we have the receivable days, the receivable collection period. Then we less off the payables payment period. So this one we less it off, and we get what we call the cash cycle. So you can refer to June 2018, question 3. It was a computational number. However, if the company deals in cash sales only, then it means it will produce the goods when the customers place an order, and then the business will not have the store for the goods. Hence, its inventory days will always be 0, and it will also have a zero. As I told you that if a company is dealing in only cash sales and it doesn't do credit sales, so it does only cash sales, then it means that company, it produces goods when the customers make orders. It produces goods as per the customer order. Meaning, it uses what we call the JIT, just-in-time approach. Whatever the customer requests is what they produces. In other words, when they receive the customer order, they make order for material to make that same product. So it means this company is not going to have what we call inventory. It will not have inventory, meaning its inventory holding period or the inventory days or period will be zero. And also the debtors will be zero because they are not selling on credit. The debtors will also be zero. In other words, the end point is that the cash operating cycle, can be zero or it can be in negatives. It can be in the negative, especially when it has payables, because remember we said we less off the payable days. If it has payables, then you are going to find that the answer, because we shall have all these as zero minus the accounts payable payment period, which will give you a negative day. So it is possible. So after computing the cash operating cycle, the examiner can ask you the factors that can affect the cash operating cycle. Remember, we gave the definition for the cash operating cycle as the average length of time between payments for purchased materials and the receipt of payments from trade receivables. How long does it take for you to receive the money for the goods that you supplied on, that you sold on credit? In other words, it's how long you are going to take to pay the suppliers from the money you got from those customers, the debtors you gave credits. So let's look at the factors. The factors affecting, this is not working capital, but this is the length, affecting the length of cash operating cycle. In other words, what causes the cash operating cycle, the cash cycle, to be long? These answers, they look to be the same like those of factors affecting working capital, but the way you explain them matters. Number one, we have the nature of the business. In other words, we can talk about the industry. It can be the industry, nature of the business, or what is the industry you are dealing in. If you are a manufacturing business, if you are that manufacturing business, then your cash operating cycle is expected to take long. It can take longer. But that of a trading business is supposed to be shorter. The reason is you are going for you to actually give these guys a lot of period, because you are selling in bulk. The amount is very huge, and you are selling to very few reliable customers or reliable wholesalers who are going to pay, but they are going to be paying at a very long period, because they have taken huge amounts of money. Number two is all about management efficiency. In other words, we are looking at the effectiveness of the management. If you are more efficient, then the receivable days will be shorter. Even the inventory days will be shorter, and therefore the payment days will be shorter. So if the management is very efficient in how it handles all these working capital elements, then we are going to have a very shorter cash operating cycle. We are going to get our cash back faster, so that we can also pay off the other guys faster. So if you manage your receivables very well, then you'll be able to pay these guys on time, the creditors, and thus will make you have a shorter cash operating cycle. But if the management is inefficient, then we expect to have a longer cash operating cycle. They don't manage their receivables, and that means they are not going to have the cash to be able to pay the suppliers on time. Number three, we have the level of sales. The level of sales, or the level of activity. Now, if the company is selling both on cash and on credit, if you have both sales on cash basis and then the sales on credit basis, then the one with cash sales will have a shorter operating cycle, because companies are going to operate depending on how they want to, the system they chose to. There are those that don't actually give credit. So if they are not giving credit, it means they will be paying their suppliers as long as they have made the sale. When you sell, you pay off the suppliers. But those that are selling on credit, then they will have a longer cash operating cycle. So the ones that are selling on cash, it means for them they don't have receivables. But these, they have receivables, so they will take longer. The other that I want to emphasize on is what we call the liquidity versus profitability. If you want to look at profitability, if let's say you are that kind of business that wants to look profitable, then you'll have to sell on credit. You have to sell on credit because you need to have a higher sales revenue. For you to have a higher sales revenue, it means when you less off the cost of sales, you will have a lot of profits, a lot of gross profit. If you deduct all the expenses, you get a bigger net profit. So you will be selling on credit to have more sales figures, and that can result into a higher profit. Because the profit and loss will be good. In other words, the net profit or loss. But if you are using this, you are selling on credit because you want to look profitable, then your cash operating cycle is always going to be higher cash operating cycle, because you are entertaining the receivables. So the cash operating cycle might be higher or longer because of the credit sales. But if the company wants to be liquid, in other words, if it looks at liquidity means you have already available money, you have cash. Liquidity means you are not going to sell, you are not selling on credit, you use cash. So if you are not going to sell on credit, means you are going to have reducing debtors. Remember, debtors are also included in the other format. So when you reduce the debtors or the receivables, you will have a shorter operating cycle. So that is liquidity versus profitability. There are those companies that want to look profitable, but if you look at their cash flow, they don't have cash because they have been selling on credit. But their income statement shows they are making profits, but doesn't necessarily mean that the cash is there in the business. So that's what we are meaning from that perspective. So now we want to look at some actions that could be taken to reduce the longer length of the cash operating cycle. In other words, if we have a longer cash cycle, what can we do to minimize it? So we can look at the actions that can be taken, that could be taken to reduce to reduce the length of the cycle, because we always want to pay our suppliers on time. Number one, you have to reduce the raw materials. The raw materials stock turnover. Stock turnover cycle. If your raw materials are being kept for a long time, then you can reduce it. If, let's say, the raw materials, you bring them and you keep them for so long, you better keep very few. You better bring and use in the business so that you can get more. Number two, we can delay payments to suppliers. Delay payments to the suppliers. Remember, we subtract payables from our cash cycle. So if you delay to pay them, it means you will be able to reduce the cycle. Number three, you can speed up the production cycle. If, let's say, you've been producing but things take long to come out of the production of the processing plant, maybe you introduce in another mechanism of how they can be able to produce the goods and they come out very fast. Maybe you can add on more workers as long as you have evaluated their impact. Last one, we can talk about reduction, or we reduce the stock of finished goods. Remember, this one is also there. It's one of the things that we add. So you can reduce it. And reducing it means you are going to be selling it. You can hire salespeople to actually, maybe you pay them a commission based on what they have sold, so that you can reduce the stock in the warehouse. So that's what we wanted to look at in that perspective. I want us to look at something new, what we call overtrading and undercapitalization. We are going to look at two: overcapitalization, then overtrading. We see the difference. Then in the end, we shall also be able to understand the undercapitalization, then undertrading. Overtrading and overcapitalization. Let's start with overtrading. What do we mean by overtrading? Overtrading, this is where you are running a business. This is where you are running a business, but the resources but the resources are not enough, to fulfill the customer needs. That is over trading. Or it could be, this could be expanding the business with limited long-term finance, and you heavily rely on short-term finance. In other words, the short-term finance are going to be used in managing the day-to-day operations of the business. But for you, you can rely on that to expand the business. Like you use that to buy things or to open up very many branches. You find yourself, you have a lot of branches, but you don't actually have money to operate the different branches that you opened up. Because by opening a branch, it means you are incurring a cost of rent, a cost of hiring people who are going to be there. If it doesn't bring in money, then we say you are over, because you don't have the money to run all the businesses, all the branches you are opening. But you are using the short-term money, because short-term money is very risky. You've just done your expansion, you have spread your business all over the country, and after doing that, then you realize that these guys are actually coming in to pick their money. You've started paying interest, which would be a problem, because if at all you had gotten a long-term finance, it would mean even if you make an investment, then it will give the business some time to generate some cash flow before you pay back the finance that you borrowed. But if you borrow short-term loans, let's say short-term loan of 3 years, and you create very many branches, by the time you finish creating the branches, 1 year is gone. Maybe you borrowed for 2 years. You find yourself, you have to pay loans. These businesses haven't even started bringing in cash flows. So we say you are over trading. In other words, if you are to do, you would have concentrated in one office, then you keep on expanding as you grow, or you borrow long term, then you use the long term to expand. So over trading, the examiner might give you a situation and may ask you what could be the causes of over trading. But I wanted to put it in a light so that we know what over trading is all about practically. You can look at, maybe if let's say you are just a startup company, you are just starting, you haven't even been in a business maybe to see the market, but you are starting, and you've started by first opening a lot of branches, even when you know you don't actually have the capital, or you've just got a small capital, you borrowed short term, and by the fact that you have borrowed, by the time you finish all this, you are going to find yourself locked up when these guys are coming in to pick their money and you haven't started even producing. So we need to know what are some of the causes. What causes over trading? The causes of over trading. An example we can look at, I think the one of Wave. We saw Wave mobile money. Wave, it was a mobile money stuff. When it came in, it opened a lot of branches, but nowadays, if you look at even where they are, you can't even see. But it opened a lot of branches in different parts of the country. Instead, they would have at least opened their headquarters. They first operate there to see whether the business is actually reliable. I know the other one could be a competition, the way of a marketing strategy to actually get people on board. But the running costs, the operational costs were high. It is still in existence, but the model they went through at first was maybe wrong, because we don't actually seem to see some of the branches that were open, some of them were closed. So some of the causes, we have overexpansion. Overexpansion is one of the cause. For example, you may have a business that produces, let's say, 10,000 kgs of, let's say, sugar. And you find that this 10,000, maybe the business is, let's say, located in let's say in Masaka, or in any of the district. But you find this is the total capacity you are producing. But you find that this 10,000 kgs of sugar can actually be consumed by the people of Greater Masaka. The implication is that if you want to see how overexpansion comes in, you find yourself producing 10,000, but you spread yourself from, but you see this 10,000 can be consumed by the people in Masaka, and it can be completed. But for you, you start looking for market in Kampala, Jinja, Soroti, Tororo, Mbale, Iganga. So you start over marketing yourself when you don't actually have the production capacity, because whatever you can produce can be consumed by the people of that same vicinity where you are located, your business. So that could be one of the reasons. If you over expand yourself, when you don't look at expanding the production capacity, then you are just wasting time. That over expansion will not bring in anything. So if you find that this 10,000 can be consumed by the people around the factory where you've put the factory, then you find your marketing manager struggling, bringing in strategy of how to capture the whole entire country, to even looking at international market, you just find yourself you're in trouble. Because by that we can say that the company is over trading, and over trading is not good. So if you are producing 10,000 kgs, or even if it is 1,000 kgs of sugar, but can be consumed by people around the factory, just market within the factory, so at that area around the factory, so that when you increase the production, when you increase maybe the units, now you can produce, let's say 10,000 kgs, then you can add on another district. And when you increase the production, you add on another district, just like that. You keep on increasing your marketing strategies vis-a-vis the production. Number two, we have poor utilization of resources. Poor utilization of working capital. Let's be specific. Working capital resources. Now, if you want to use your working capital maximally, if maybe you have used well of your working capital, for example, you have managed well your receivables, you have managed them, they are paying you early, then you will be able to have the capital that you can use to plow back into the business. But if there is poor utilization of the working capital, you find that you can't manage your receivables. You are not even marketing your products that you are producing. How do you expect to be able to have those in place? So if you are investing the money, the cash you would have used maybe to invest into the business, and you start opening branches where you don't even have the stock to fulfill the market that you are demarcating, you'll have problems. Number 3, we have undercapitalization. Undercapitalization at the inception. At the inception of the company. In other words, you don't have enough capital at the start. You put in less money as capital at the start of the business. So if you start a business and you open up very many branches, but you lack the resources or you lack the money to operate those many branches that you have opened, then that will be called overtrading. Number 4, redeeming the long-term loans without replacing them. Without replacing them. Without replacing them, or by replacing them with short term. By replacing them with short-term source, short-term loans. This is not good. If let's say you had borrowed maybe 1 billion, and you had maybe purchased a plant for producing a processing plant for processing the products, but you find that instead of having your capital, instead of increasing your capital, you start paying off this loan. Maybe you get short-term loans and you use that money to pay off the long-term loan. It doesn't really make sense, because at the end of the day, you're going to find yourself not having money to run the operations of the business. Or some of them, you pay your mortgage and you remain with nothing. You can't even operate, but you clear the debt. You just say that I don't want to have debt in my capital structure, but you don't actually have even the cash that you are going to use. So if you are to offset the long-term loans, make sure you have already acquired your own source. You have already acquired more cash that you can use in the business after clearing the other long-term loans. So, because it may happen, someone may say, I borrowed, let's say, if you are maybe operating and you had 100 million of loan, this is a long-term loan, and you find that the loan is paid back by acquiring a new one. Because you'll get a new one, but it is short term. It can be short term, but it has taken all the money to clear this. Instead of using this money you have borrowed on a short term to actually cater for the operations of the business. So if you clear this, it means even this money is gone. That means you will be left with nothing to use in the business. So those are some of the things, the causes, but there are very many you can read in that study pack. But let's look at something small. What are some of the symptoms? I told you this is science in theory and science. We need to look at symptoms or the signs of overtrading. How do I know that this company is actually overtrading? Those could be the symptoms. How do I know that? One, you may find when there is shortage of cash to meet the company's obligation. The company's obligations, especially when all the debtors have paid all their company money, especially when creditors have paid, especially when debtors have paid all the company money. So you can't say that the people you were demanding, they have already paid you, but you don't actually even have money to pay off the other people. Yet what you are demanding from the debtors, they have already paid you, so you know there is overtrading. Two, fast growing businesses which lack cash resources to support opportunities brought about by the rapid expansion. They have over-expanded, but they don't have the cash to support their expansion. Fast-growing businesses. Fast-growing businesses which lack cash cash resources to support the opportunities brought about by the rapid expansion, by their rapid expansion. Because you can expand. Number two is fast growing business. Fast-growing businesses which lack cash support. Cash support or cash resources to support. Let's use cash resources to support opportunities brought about by this rapid expansion. Now, for example, a company can be receiving sales contracts because you've operated in very many districts, so you are going to be getting different contracts from different parts where you are located. But you'll find that you have just started the business. You are just at the inception of the business. You have just started the business, or you have just started a factory, and you haven't even started manufacturing. But for you, you are calling for people. You bring in contracts. We provide this and this and this, yet you haven't even started manufacturing the products. You start receiving people's orders, yet you haven't even started the real manufacturing. We may be seeing the office or the factory, but you haven't started making the products that we are going to buy, but you are calling people to come and give you contracts, or you sign contracts for people that I'm going to supply such and such, and you find at the commencement you can't even fulfill these guys' orders. So you were over trading. That is one of the ways you can see that there is over trading. Number 3, there is also failure to deliver on time. To deliver on time and seeking to extend delivery time. Because it's going to happen that you've received very many orders, but you don't actually have the products. So you are going to find yourself not actually delivering what you are supposed to deliver on time. For example, if let's say the company receives an order for goods, but it fails to deliver the order of the goods paid for, and you start seeing them negotiating with the customer, add me some days, add me some time so that I can make your delivery. So that's one sign that these guys are actually over trading. They want money, but they don't actually do the thing in the right time. That's a sign of over trading. Number 4 is relying. You find that the company is relying on short-term loans. Short-term loans other than long-term finances. To finance all the company activities. Finance all the company activities. So you find themselves fidgeting. They get this money, they have to pay it back in a very short period of time, instead of getting a very long-term source of finance where they can make their investment and they pay later when they have started making profits. So as you see the companies relying on very short-term loans, just know they are over trading. For example, when you see companies expanding, but when you look at their balance sheet, it uses more of short-term sources of finance than the long-term, then just know there is a problem. There is an element of overtrading. The other is very rapid growth. This rapid growth should be in sales. Very rapid growth in sales. Rapid sales growth can't be projected. Like you find in the guys have a lot of sales revenue than what they actually produce. If you look at the cost of sales, is very small, but the revenues are very high. Meaning these guys must have gotten the money before even delivering the products. If you see that the company has been selling 10 kgs, maybe 100 kgs of sugar, in let's say in a month, but you see in 1 month, they have over 3,000 kgs. You'll be wondering, because how are you going to forecast for the next month? There is no way you can forecast. Then the other time you find that maybe they have now gone back to 150 kgs. How are you going to do the forecasting here? So this kind of rapid growth, which can't be explained, is a sign of overtrading. The reason why I'm giving you these scenarios is because they may give you a case and you're supposed to identify. If they give you an income statement and they tell you, help us know if there is overtrading or there isn't. So you can look at some of these aspects that I'm talking about. Another is an increase in stock levels. Stock levels as a proportion of sales. This means slower stock turnover. The stock doesn't actually move. The stock levels are increasing, but if you look at the sales are not there, but the guys have stock. Just know there is a problem. For example, when you look at the balance sheet, the stock or the inventory is higher, but the sales are not even growing in that same proportion. You see, they are stocking a lot than what they are actually selling. So you find themselves overproducing when they haven't even determined the market where they are going to sell the products. That's a sign. Lastly, or second last, we can look at the liquidity ratios. You find that these liquidity ratios are worsening because liquidity ratio looks at the liquid cash. Lastly, we can look at maybe even the profit margins. Profit margin keeps on falling. Margins fall. Where you see that the inventory is increasing, but the sales are lower, plus also the profit. However, overtrading is characterized by imbalances in cash inflows and cash outflows. The challenge of overtrading is to balance these two ideas, balancing off the cash inflows and the cash outflows so that the business can meet its obligations promptly as they occur. So you find that their inflows and outflows, they are not matching. And they have a problem of balancing those two aspects. That the inflows are very small, they can't even cater for the outflows. So you have to be relying on debt. And moreover, you are picking short-term debt to cater for the different aspects. Now, how can we avoid overtrading? These are the mitigation ways. How can we avoid? How can overtrading be avoided? We look at some of the ways how we can be able to avoid overtrading. And these ones, you just get their reverse. Like if they are using short term, you tell them focus on long term sources of finance. So they are very straightforward, but let's have some. Number one, we can increasing the capital base, where you need to look for long-term finance in order to manage your working capital requirements very well. You have to get the long-term sources or long-term debt that are going to be used to carry out the long-term investments. Then you use the short-term for only working capital management. Number two, you can reduce the level of activity, reduce the level of activities. You may find that the company, at the inception, you find that they are providing auditing services, they are providing tax services, they are providing QuickBooks. But if you look at the capacity, the company employees, they can't handle all those aspects. If it is audit firms, you find an audit firm requesting or accepting a contract they can't even manage. They are short-staffed, but they are looking for a big organization. How are you going to audit it? So those are some. You can reduce on the activities that you do. You prioritize on all your efforts on certain key ideas that you see they are going to bring in cash flows. So if you can't fulfill some orders on time, then you reject some orders, or you explain to the customer before taking the order that if you make sure that you have chosen to buy from us, make sure you are able to wait maybe 2 weeks to receive your delivery. Than picking the money, at the time of picking the money, you are saying you are going to deliver tomorrow. Tomorrow reaches, you says, give me some 2 days. So that's what we are meaning. If at all you can't handle certain things, say this and this I can't handle. Lastly, we can talk about maintaining tight control. Maintaining a tight control. A tight control over working capital management. Working capital management. Because we said one of the reasons as why we are seeing it is because they fail to manage their receivables. They fail to manage the cash they have. So by you making sure that you have constant reviews of the working capital policies, then you can be able to sort over trading. So that's all about over trading. Let's now look at overcapitalization. Now, overcapitalization, it occurs when the entity uses especially more of equity, not debt. Where this always happens is those companies that basically use equity. You find that when the equity of the business is in excess of its business operating environment, they have more money than they can use in the business. You find them, they are paying a lot of money to the employees for nothing totally, they are doing. You find the kind of work they do is very small compared to the amount of money they are paying the people. So that is just overcapitalization. When you have too much money as compared to the activities, you have the money but you are not investing it. You are not expanding the business. It is just the opposite of overtrading. Overtrading, you expand when you don't have money, but here you have money but you don't want to expand. So you find that you have a lot of money in the business, but the operations, they are very small. In other words, you find that the company has too much money than what they can use that money for. That's basically overtrading. So this occurs when the equity of the business is in excess of its business operating environment. So they have more money than the activities they are doing. So let's look at some of the features or the characteristics. So we look at the X-sticks or features of overcapitalization. Number one, earnings. The earning capacity being lower than the available capital. If you look at the balance sheet of this business, they have a lot of money than the net profit they have. The amount is very much as compared to the activities they are doing. You find that the business has share capital of, let's say, 10 billion. But you look at their sales, they are not even a billion. So you find that they have overinvested a lot of money in the business than what the business is actually providing. In other words, if you try to look at the earnings of the company as compared to the amounts, you may use it because you may find that these guys, maybe they have their own money, they are not paying. That's why maybe they are reluctant even to carry out the investment. They are just keeping their money in the business. But there are those companies whereby they have even borrowed the money. But when you look at how they are doing their investments, it's really something else. Because some of the factors or some of the reasons that why that may happen is, if let's say you hire someone and maybe you are hiring your CEO. The CEO, you are giving them a contract of, let's say, 2 years. So this CEO, they are looking at, their contract is only 2 years. But what they can do, they can make investments that can materialize within their year of contract. Meaning they are going to be doing short-term investments. because they don't want to do projects that will materialize when they are not there. The chances of them being the same CEO, especially when contracts are renewed based on how you have performed. So you'll find these guys are going to be doing more investment in short-term aspects because they want to have the returns when they are still within their working contracts. Then when you have hired someone and the contract is open, someone will do an investment, even if it will bring in returns later, maybe after 2 years or after 3 years, but they know it will bring in some returns. So this, you may find that you are just restricting the CEO to carry out some investment, some risky investment that may be profitable to the business because of the contract engagement that you have with them. So they just don't want to lose the money because of they want to have security for their contracts. So that will be some of the issues. So you find the earnings are small compared to the amount you borrowed. You borrow too much, then you get less. And when you get less, it means you are going to pay less in dividends. Since the company has a lot of money, because having a lot of money, it means you borrowed from so many people, but you have gotten less to distribute to those guys. So you find that the company has a lot of money, but it has never invested it to earn more money. The other one, we can talk about the turnover. The turnover period. The turnover period. We can also look at the long term, the turnover periods for the other receivables. So the longer the turnover period for the inventory and accounts receivable, you'll find that this one is going to have a longer turnover because they don't care, they don't actually need the money. They have already the money. Even these people they have given on credit, they are keeping the money for so long. And you find that these guys pay early. Because the cash is there in the business, they pay the suppliers very early. You find these guys have stock. The stock doesn't move, they don't sell, whether they don't even market. So those are some of the things that we are seeing from this perspective. In other words, when goods are manufactured, they end up staying in the store. Yet stock shouldn't be manufactured to be kept in the store. If you see that you are going to manufacture and keep, maybe you are just waiting, it is a strategy of where you are looking at raising the market. Make sure then you don't produce, because if you produce, we are incurring additional storage costs. So the other, we can have even excess inventory. Excess inventory. We can also have excess accounts receivables and also excess cash. So you have excess cash, but you have few payables, accounts payables. That's what I was explaining. So cash is just lagging into that current assets. So let's look at some of the advantages. Advantages of over capitalization. Advantages of overcapitalization. These ones you can give them. They are able to utilize the opportunities as they come because they have the money. They are capable of recruiting whichever experienced staff that the business need. They are capable of enjoying any investment that may happen. Even they are capable of enjoying discounts because they can actually pay the suppliers on cash, using cash. So, one, we have increasing the capacity to meet competitive challenges. Because they have the market, they can do anything. They have the money. So, when more money is available, they can beat off all the competitors. Because they can be able to do anything that can help them to get the market share. Number two, it is easy to undertake expansion. Easy to undertake expansion. Easy to undertake expansion projects because cash is available. Expansion projects that can yield more returns for the business in the future because cash is available. Three, putting the minds of the managers at ease. It helps to put the minds of the managers at ease. Since the possibility of lack of long-term fund is eased. Because companies are struggling to raise finance to fund their investments, managers are going to be thinking where they can actually get the long-term sources that they can use in the business. But if the money is available, then it eases the work of the managers. But at the same time, it makes them dull because they don't actually think. They would have thought of looking for ways how they can actually get cheap funds and how they can be able to invest. Because if you borrow, you have to make sure that you get back the money, you pay off the debt holders and remain with something. So you are going to make people lazy because cash is there, more so when it is more of equity. So let's look at some of the disadvantages. These disadvantages or the demerits. Demerits of overcapitalization. It's not sustainable. Not sustainable. Not sustainable to accumulate capital that is, it's not sustainable to accumulate capital that is not justified through generating fair returns. You have borrowed the money, but you are keeping the money. Fair returns on investment. It would be bad if at all you had borrowed the money. In other words, if you have too much money, then we should use it to make more money. And if you have a lot of money, but it's not generating any return, then it's a problem to the business because people will end up stealing it. Number two, shareholders will be dissatisfied due to low returns on their investment. The shareholders will be dissatisfied due to low returns on their investment. Because it is the shareholders who brought in the money, but you are paying them less because you are making less. Since the company makes less profits, hence paying less dividends, yet the money was available or was invested by the shareholders. So the shareholders, they end up becoming dissatisfied. Number three, excess capital may encourage less optimal investment. Or less than optimal investment. Like speculation, because you find that since excess equity is available, you find that you can't go in for these speculative businesses. You are not sure whether you are going to earn money from there. Then let's look at the warning signs. The warning signs where you can see that actually these guys have overcapitalization. Warning signs of overcapitalization. Overcapitalization. So these are some of the signs. One, fast expansion. Fast expansion of fixed assets to maximize wealth. To maximize wealth without providing corresponding growth. Without providing corresponding growth. For example, you will be seeing companies buying expensive cars for their MDs, for their staffs, and they are not using them in the production of cash to the business. You find the company own very many assets. Whatever they see, they buy, but they are not even using in the business. But if you look at the balance sheet, is very huge, but they are not using the money in the business. Two, there is fast cash growing operating cycle. Fast cash growing operating cycle. Due to too much production as a result of fast expansion of fixed assets. They produce, but they don't sell. Three, we have quickly decreasing cost to support the additional investment in fixed assets. You find them, they are not adding. They have made the investments, but they are not making some additional investments to make sure that the assets they have acquired, they are functioning. They are bringing in cash flows to the business. Then the current assets, like the debtors and the inventory, they are rapidly increasing due to excessive capacity to produce. meaning there is overproduction. Overproduction because they have the capacity to do what? To produce, but they are producing and they are keeping there. So you can look at the reference number, the reference question. It is question 2, November 2018. Question 2, November 2018. It was actually examining this. So, having seen that was just an introduction of what we wanted to look for. Remember, the topic is management of working capital. And management of working capital, we are looking at elements. We've seen that there are elements of cash, there are elements of inventory, there are elements of debtors or receivables, and there are elements of accounts payable. And we said for accounts payable, we don't manage them, we are supposed to pay them. So we have to look at each of these items in detail. So we are going to start off with the inventory. Then we do cash next. We shall look at receivables last. The receivable will be, because the receivable is a bit wide, we shall look at it in its separate video. But these two, we are going to look at them. So we want to start with inventory management, and we want to start to look at management of working capital, and we want to look at the first component or the first element of working capital, which is inventory. So inventory management. Let me create a background for this. But what we had looked at earlier was just an introductory part to working capital management. But what we are going to start with are the components, management of each component of working capital. Because what we first dealt with, all of that was just an introduction, giving us an overview of what managing working capital is all about, where we looked at the cash operating cycle in detail. We looked at the factors that influence working capital. We looked at management of working capital, given the components and the elements. We looked at over trading and over capitalization. So when we talk about working capital management, it means management of each element or component of working capital. And the components, we said we have inventory, cash, receivables, and payables. So we are picking one by one and we talk about it. And as I said, we are going to start with inventory management. We do cash management, then receivable management will be another video because for it is a bit wide. We need to look at it separately. Management of receivables or debtors. So the issues are going to be on inventory management, cash management, receivable management. But payables or the payable management will have nothing to talk about in that, because there is nothing that we are going to manage And I emphasize that you always pay our suppliers, because if we don't pay them, then we will reach at a point where we will crash, because we will not have raw materials or even cash, because you don't have the raw materials and you don't even have cash to buy from other suppliers. And even when you have cash, they may connive, these suppliers may connive, and they say, those guys make sure when you're dealing with them, they pay you, because they don't pay. So it tarnishes the company's name. So there, we don't manage. That's just a precursor of what we looked at. But let's now begin on management of inventory as one of the 3 elements that we are going to be managing. Now, when we are talking about management of inventory or inventory management, we look for something called optimal. Let me write it in big letters. Optimal. In other words, we look at what is optimal or what is ideal. It's not the minimum, it's not the maximum, but we look at the optimal. So, we want to find out what is the optimal inventory, or what is the ideal inventory, or what is the ideal cash the company must have, and how much can we invest. Because for you can invest all the cash that you have, but the point here is that we should always have some cash in the business despite investing heavily. The same applies to inventory. Even when we are selling, we've produced a lot, we are supposed to have something, the optimum amount of inventory that is supposed to be left in the business. Not sold, but it is always available in the business. Even in the cash, however much you are investing, make sure there are some optimal inventory or optimal cash. So, when we are dealing with inventory management, when you get the raw materials from the customers, from the suppliers, the raw materials, you certainly produce goods. And after producing goods, you get what we call inventory or stock, which must be sold, to the customers, must be sold to the customers. But the idea of managing inventory is that all inventory is not supposed to be sold. In other words, not all inventory must be sold. We need to remain with some stock. Therefore, the whole idea is how much of that stock or inventory that we have produced must remain in the business. Therefore, it will be the optimum amount, or it would be the optimal level, and it's what we are going to concentrate on. Even for cash, however much we are going to be investing, we need to determine the amount of cash that we should have in the business, and it's supposed to be available, and that cash must be the optimal cash. So that's what management of inventory, management of cash means. Now, what will be our concern? If we talk about investment decision, what is our concern? Our concern as far as inventory management is concerned, is that we need to trade off. We need to trade off between profitability. We need to trade off between profitability versus liquidity. We need to trade off between profitability versus liquidity, especially if you are to manage inventory. When managing inventory. So the only way we are going to be able to manage inventory successfully is by trading off between profitability and liquidity. So whenever you look at working capital management, the bottom line is, how do you trade off between profitability and liquidity? That is the bottom line. Whenever you're looking at working capital management. Therefore, trading off between profitability versus liquidity, what is the implication? It's like weighing. You keep weighing these two options. If, let's say, you have a weighing scale, let me say this is our weighing scale, and here we have item, and here we have an item. This item is called profitability, and this item is called liquidity. So these are the two items that we have. And we need to make sure that these two items are balancing off. When they are balancing, we say we are trading off. We need to find a balance. So it's like the way you can have a weighing scale where profitability is on this side and then liquidity is on this other end. But since both these two aspects are important for the organization, we must play it around so that the two remain balancing. They are supposed to be balancing. We have to maintain them. If this is 10, even this one should be 10. If this is 20, this one should be 20. Not saying this is 15 and this is 10. No. They are supposed to be balancing. Now, when dealing with inventory, if you process and you fill your store, then you are most likely to be profitable. Because this is the implication. If I've produced my goods and they are in the store, the goods are going to be in a store. As long as I produce very many and I keep in my store, I'm profitable. Profitable in a sense that when I prepare my financial statement, I will have more net profit. So when you produce and you fill your store, you are most likely to be profitable because the stock to be sold is available. Because these goods they are produced, that is stock for you to sell off. Because whenever you are preparing your income statement, we always say it is sales minus less cost of sales. After lessing off the sales return, you less off the these are always net sales. Let me be specific. These are always net sales after lessing. So you always say net sales minus cost of sales. So you always less off the cost of sales from the net sales of the business. And within this cost of sales, we have opening stock plus purchases. But since we are producing, we shall put production costs. We add. But since we are keeping these inventories in the store, remember here we less closing stock. Now this is the trick. If you produce goods and you keep them in the store, meaning you have not sold them, those are going to be your closing stock. It is going to happen like, if let's say the opening stock is 10 and our purchases are, let's say, they are 140. That's going to give you 150. Now we are supposed to less off the closing stock. Just imagine that we produced more and we kept in the store. And let's say our closing stock will have so much that we have, let's say, 110 closing stock. So it means the cost of sales is going to be less, which is going to be 40. Are you seeing that if you get your net sales minus 40, you are going to have a higher gross profit? A higher gross profit will come out because of you keeping more stock. Remember, you are holding stock. It is within the business. After you produce, you keep. So the closing stock that you deduct is like, because this closing stock, remember, we less it. Lessing it means it's as if you are adding it to your sales. That is the implication, because we are lessing it here. Otherwise, if we are doing our own way, we would say net sales plus closing stock. It would mean the same thing, because you will have, if the net sales here, they were maybe 2,000, it would be 2,000 minus the 40, meaning someone is going to remain with some good 19. This is 60. Now you see, now just take for instance, if at all we remain with less stock as closing stock, if let's say we are remaining with only 20, maybe 10, let's just say 10 from here, we are remaining with the 10 alone. It would mean that now our cost of sales that we are going to less from the net sales will be 140. So if you get the 2,000 minus the 140, are you seeing that you are reducing your profit? Your profit when the closing stock was high, it was 1960. But now we are getting 2,000 minus 140. Are you seeing we are now getting 1860? We've lost what? We've lost 100 just by mere reducing the closing stock. Are you seeing that this gross profit of ours has reduced because of a reduced closing stock? But when you increase the closing stock, the stock will remain with, we are technically increasing our gross profit. That's what we are meaning. That by you having more products in your store, you are likely to be more profitable. That's the implication. And if you reduce your store below the minimum amount, then you are going to be reducing your gross profit. Meaning, by reducing the gross profit, you will be having a lot of money because you have sold all your store, so you still have cash. So that's the implication. So if by maintaining less, your profits are reducing, meaning the liquidity will be high because we will be having a lot of money because we have sold more. But by us having a higher closing stock, we shall be more profitable in the income statement. So to make sure that we trade off, we need a balance. We need that optimal inventory level that will make sure that profitability and liquidity are balancing. They are all weighing the same. If this is 10, even this one is supposed to be 10. That is the mathematics, or that's where we are heading. So I told you, if you have a higher closing stock, it's like adding it to the net sales, meaning you will be having a higher gross profit, since the closing stock is going to be reducing the figure for cost of sales. Hence, we shall be more profitable, meaning profitability will be achieved. And if it is lower for the cost of sales, then we shall not be having profitability. Therefore, when the store is full of stock or inventory, then profitability will be achieved. But the problem will be that there will not be cash to run the business, because instead of us selling the goods, we are keeping the goods, meaning we shall not be having cash to manage other issues. And having cash is what we call liquidity. So if the company brings or produces goods and sells it faster, then it will have cash, which we call liquidity. but the organization will not be profitable since the company will not have the closing stock, will not be having closing stock. Hence, the company should trade off between profitability versus liquidity approach. So that's the trade-off. It is really important and it is very technical. The same way I've explained it, they may actually give you the reasons. They may tell you what are some of the issues, and you find yourself talking about some of those scenarios. So, under inventory management, we need to trade off. So it is important that under inventory management, we need to trade off. To trade off, and to trade off is to look for the optimal, that amount that is in the middle that will help you balance the two aspects. It's looking for the optimal inventory. In other words, the trade-off, what will be the meaning? Definition-wise, trade-off will be the optimal inventory. And that optimal inventory is what we call the ideal. In other words, this is how much inventory should the company have that will make the company profitable, but at the same time having some liquidity. In other words, having some cash. And that should be the essence of inventory management. And therefore, we should now look at if we try to look at the notes that we have, if you look at our workbook, because I was explaining it out, I was giving it a context. In other words, if you look at our workbook, the issues that are there, I've just summarized them up. So, our concern is basically for us to look at the trade-off. In other words, we look at the optimal inventory level or the ideal inventory. But when we talk about inventory, we should know that if you are a manufacturing company, then you have different aspects. That one is also important. Before we look at the trade-off, there are some few concerns that we need to address and understand. There are issues when I talk about inventory for a manufacturing company. For a manufacturing company, just know I'm meaning three things. There is what we call the raw material, that is inventory of raw materials. Inventory of raw materials. We have inventory of finished products. We have work in progress. Those are three issues, inventory items that we have in a manufacturing company. While for a trade business, we have that trading business. The inventory they have is only finished goods. They have only finished goods. Whether they are going to be wholesalers, whether they are retailers, they have finished goods, one product, meaning their inventory is made up of only finished goods. So we need to be careful on that. So we need now to understand what could be some of the benefits of holding stock. Before we have all these aspects, what are some of the benefits of us holding stock? We said the stock is the same as inventory. Why companies should hold stock? Should have at least the optimal. Remember, when we talk about holding stock, we mean the optimal stock. Why is it important? The examiner may ask you why you should hold stock. In other words, why you should keep some inventory in your business. Number one, to ensure that production process is not disrupted, especially when the factory works, especially when the factory operates for 24 hours. Factory operates for 24 hours. In other words, this would be for raw materials. We keep those raw materials because we don't want the production process to stop just because we don't have raw materials. As you see that it is about to get finished, order others. So you should have that minimum, it's not the minimum, but it's the optimum amount of inventory or raw materials that should be there in the business, not sold. So for raw materials, if they are there, we find ourselves not disrupting the production process because we taken care of the issues. Because for you, by the time you go to order raw materials, what if now you reach there when the supplier is not reliable and you find maybe stock is not there, and we keep waiting? You will keep using this optimal step until the other one comes in. So that's the reason we don't want to disrupt. We want to have a steady supply of raw materials to the production process. Because by stopping the production, you are going to explain a lot of issues. Now, what if people had made their orders and you are delaying? Number two, it might be profitable to keep large quantities. To keep large quantities of stock as a result of bulk purchasing. Bulk purchasing. When wholesalers go to the factory to purchase goods, they always buy in bulk numbers, like they buy in large quantities. So for them, they end up buying large quantities. And in the end, they get what we call the purchase discounts, hence reducing their credit sales. Because what is going to happen, you may get a customer who says, I wanted to take maybe 10 tons, and you give me at a price which is lower, at a price which is a bit lower from the normal selling price. Because someone is taking in huge numbers, you find yourself giving them discounts. So if you don't keep too much stock, you will not benefit from that as a company. Even the other side of if you are buying raw materials, it would be the same. The other guys who are selling raw materials, they may find they are supposed to keep a lot so that they can give discount to people who are going to come in and buy in bulk numbers. Because by you giving these guys discounts, you are chasing credit sales. Because by chasing credit sales, it helps you to have cash in the business. At times, buying in large quantities reduces the number of orders in a year. It reduces the number of orders made or to be made in the year. If you buy in bulk numbers, remember every time you place an order, you are incurring ordering costs. So by doing so, you are reducing on the ordering costs. So hence reducing ordering costs. Because these are costs that you are going to incur as long as you make an order. But if you don't make an order, it means you will not pay those costs. The other one, it is even a competitive approach. It's a competitive approach. Because it is a competitive approach to have larger quantities of stock. Because if you run out of stock, then the customers might go and buy goods from your competitors, and they may not even come back because they may reach there and they give them good customer care and you end up losing. But also, those are some of the advantages. But you need to understand that if you stock too much quantity of inventory, it comes with costs. There are costs that are going to be associated with stocking more. So we need to look at these costs. May be the disadvantages of high stock, but we call them costs of high inventory level. But these are the costs you are going to incur, because when you keep more items, you are going to put cameras, to even pest controls, and also stock taking every time to see, even goods just losing weight, because when you keep them, you may keep. So the costs of high inventory level. Whenever we talk about the costs of stocking, the cost of stocking more inventory, then we are discussing the challenges associated with having higher inventory levels. We are not necessarily looking at the costs in terms of money, but we are looking at the costs, the challenges that are associated with higher inventory. But there are also challenges that are associated with the lower inventory. We are going to see that after this. So one, we have the purchase costs. Now, in most cases, if you purchase and hold your inventory, and it is in bigger numbers or bigger quantities, then it means a lot of money will be tied up in those inventory, and the company will not get the return it would have gotten if at all it had invested the money outside. In other words, that would bring in something to do with opportunity cost. So by you buying these items, you are actually foregoing the other item that you would have done, that you would have bought with the money, or that you would have invested in with that money. So by keeping large volumes of inventory, you are tying your money that would have been used to earn returns if at all you had invested that same money that you used to buy those inventory into other business venture. So that is a cost or a challenge. If you buy a lot of inventory and you have to get the space where to store them, then you are going to be incurring what we call storage and administration, because if you put them in a store, it doesn't mean that they are going to manage themselves. You are going to hire someone to actually clean, maybe sweep inside, be opening to make sure that these goods are going to get fresh air. You are going to be incurring storage costs, storage and administration costs. Number 3, there are also other risks. There are other risks associated with keeping stock. Once the goods are in store, then these goods will need to be insured. So we will be incurring what we call insurance costs. So these goods, by insuring them, it's a cost because some of these inventories will need to be insured, otherwise they will be stolen. So you'll find yourself putting in maybe the CCTV cameras so that, and buying these cameras, it's also a cost to the business. So you need to have burglary proofs so that at least the store can't be invaded by thieves. So you find yourself you have to incur costs just by mere keeping the stock in a given location. The other is stock itself is a challenge. The stock itself is a challenge, and it often suffers losses. These losses can be through damages. If you store maize, you find by the time you come to look at it, maybe after 3 months, you find that the maize has started developing holes. It could be even deterioration, even expiring. Goods may expire when they are in the store. So these are some of the costs or the challenges, but there are also costs or challenges. The costs or challenges of low level of inventory or stock. Number 1, we shall have stock out costs. Take for instance, if let's say you received an order, and that order is supposed to be fulfilled in a given period, and you find yourself not fulfilling it because you don't have the stock, then these customers, they can actually sue you, and you end up paying legal costs. So those costs are going to come as a result of you not having enough stock. So the stock out costs. So as long as you don't have stock, then you run out of stock, and hence causing interruptions in the production process. When the stock is not there, we are going to run out of stock. And when we run out of stock, remember the stock we are talking about, it can be raw material, it can be work in progress, it can be finished products. The other is even ordering costs. We are going to be having more ordering costs because we don't have, when you purchase low volume of inventory, you are going to have to incur ordering costs. You will always keep on ordering, and it's a cost to the business, since the ordering cost will increase as more orders are placed. The other, we can look at, the company cannot also benefit from discounts, bulk discounts. The company cannot benefit from discounts because you always buy small quantities. Discounts as a result of low stock levels. So those are some of the costs that are going to be associated with either having low or high inventory levels. So you are seeing at every point there are costs or there are challenges. If you have low, it's going to be a problem. If you have high, it's going to be a problem. So for you to manage your inventory, you need to have the optimal inventory level that will make sure that you balance between profitability and liquidity. So let's now look at the inventory control terminologies. Let's look at some of the terminologies that we are going to use under inventory control. As we manage our inventory, there are some words that we need to first understand. So if some of these terminologies you don't actually know them, then you'll find it hard for you to actually know their meaning and to be able to carry out these computations. Number one, we have what we call the lead time. The lead time, or I can call it procurement time. Procurement time. And we are just giving definitions for these key terminologies. It is the period of time and it could be expressed. It's a period of time that could be expressed in days. It could be in weeks. It could be in months, etc. Between ordering and when the goods will be provided to you. Others, they call it replenishment period. In other words, when the goods are available for use, it looks at when are we going to have these goods available at our premises. Now, for matters of understanding these concepts, we need to know that we are dealing with bigger corporations, because when big corporations buy in large numbers, it takes some time for them to receive the goods. It may be due to maybe shipping delays, because just imagine you are buying raw materials from China. They will take some time to reach here. So for you to be able to understand these inventory management controls, you must be able to understand that we are dealing with bigger organizations that can buy, maybe they are buying spare parts from China, from Japan, from Germany. So they may be delaying. It takes some time from the time they have made an order to the time when they are receiving the goods. So the duration it takes for them to receive the products is what we call the lead time or the procurement time. And the delays that could make the lead time to be longer or shorter, it may be in terms of maybe shipping delays. It could be production delays. Because for you may request for a certain part or a certain product, but they are still manufacturing where you are requesting it from. So if that's the case, then the delay is not going to be like you are the one who initiates the delay, but the delay comes, it is in the process. So it will take some time for you to receive the goods you have. The other case may be in terms of the distance. As I said, if you are shipping from China, the distance from China to Uganda is catered for. If it will take longer, depending on the mode of transport you have used. Those might be the shipping delays. Maybe you have used a different mode of transport. So there is always that kind of stuff. But the period it takes to reach where it's heading, it's what we call the lead time. For example, if you look at these guys who order fuel, if you have an fuel order, maybe you have sulfur orders. They may take time, and others, so they may take time to reach the desired destination or your operation places. That's number one, terminology number one. Number two, we have demand. Most of the times we call it annual demand, but I just want to explain it as demand. Now, demand it's the amount required. The amount required by maybe the sales department or the production department, whichever department that may be in need of the products. So it is the amount required by the either sales department or the production department, etc. In other words, when you look at a factory, there is a sales team, and every time the sales team will demand for finished goods or the finished products, it will request it from the production department. And even in the production department or the production team, they may also demand raw materials, because it's going to be a process. The sales team may say, we need 10,000 tons of, let's say, sugar, but they will send in their orders in the production if it is not yet produced. Then you'll find that these people of the production, because they are the ones who know which raw materials to buy depending on the order they have received, then they will go for raw materials. So it will be in that, it will depend. They will also have, basing on what these guys want, they can guess, they can estimate that if you want 10,000 tons, then maybe we shall need 20,000 tons of raw materials so that we can get 10,000 tons of finished products. So this is usually expressed as a rate of demand, and it could be per week, it could be per month, it could be per year. So when you're doing the computations, we shall need to, you always need to know how you are going to express, or how they have expressed the demand. If the examiner has given you in per months, weeks, you go by what they have given to you. If it needs conversion, you take it in that perspective. Now the other is we have what we call a buffer stock. A buffer stock, or what we call a minimum stock, or what we call safety stock. Buffer stock, minimum, or safety stock. And this is, it is a stock allowance. It is a stock allowance to cover errors in forecasting. In forecasting the lead time or the demand during the lead time. For example, if let's say you have put in an order, for raw materials, maybe you need 10 tons of raw materials. To help you in the production process. But the lead time, all the time it takes between when you put in an order and when the raw materials will come, it's going to happen that by the time for you request 10 tons, the factory is not going to stop operating so that they can wait for you to first receive the 10 tons of raw materials. It will keep producing, meaning there is that stock they are going to be using as they are waiting for the stock you have ordered to reach. So as the factory continues to operate during that lead time, then it means that raw material that they are using at that very time is what we call the safety stock. It is now the safety stock it will be using as it is waiting for the raw materials to reach. Because if you order these materials after you have used 100% of your last request or your last order of raw material, then you are going to make the organization to the factory to stop running so that they wait for the raw materials. So you make the order when you still have some raw materials, and that some raw materials is what we call the minimum, that it is going to cover the time or that lead time that it will take for you to receive the next consignment of raw materials. So that's the buffer stock, safety stock, or the minimum stock. The other one is the maximum stock. Now for maximum stock, these are stock levels selected as the maximum desirable, which is used as an indicator to show when stock has have risen too high. In other words, we are looking at inventory management. So as a company, we will reach at a level where we will say that this is our maximum stock, the maximum we can use, and we must not exceed, or we must not go beyond that. And if we go beyond that, then it will cause a problem to the organization. Either you will be having high stock levels, and that high stock levels will result into what we call overcapitalization, which situation that we talked about. But as a serious organization, you need to know that in such and such a period, this is the maximum I can use in my production process, so that you don't exceed, because even if you exceed, you will not utilize what you have brought in excess. So if you bring in more, it means you are going to keep more stock in the business. It will create the other divergence that we talked about of balancing between profitability and liquidity, because you will be having more stock, which will increase your profitability, but cash flow wise, you will not be having the liquidity. And that brings us the situation of over capitalization. which is not good for the organization. So that's the maximum stock. That is the maximum we can have in a business for a given period of time. The other is the reorder level. The order level, this is the level at which a further replenishment order should be placed. So it is that stock level where a new order must be placed. It's not the safety stock, but it's above the safety stock. That at the time that you see you have reached at that point, make sure you make another order for either raw materials or finished products, so that by the time it goes below to the safety stock, at least even the other order is about to reach. Because the assumption is that if you just set only the minimum stock level, all the safety stock, all the buffer stock, it will cause a challenge, because that level is always below the reorder level. And the reason as to why they put it below the reorder level is basically to help us see that if we have reached at this point, we are in very big trouble. In a sense that if we find that we have reached that stage and the supplier has not yet supplied the goods, like from that point, we make an order, an emergency order, because we know this was just a safety stock that we put aside that we shouldn't go below. But for the reorder level, it's the level that we set, and it is always above the minimum stock level, just to make sure that when we reach at that point, we straight away make an order for more stock. And when that happens, by the time the stock moves from that reorder level to the minimum level, we expect that the other order must have reached. Because if it's not available and we have reached the minimum stock, then it means we had challenges in estimating our order, the lead time or the procurement time. Remember, this stock, the safety stock is for catering for the errors in forecasting the order period. So you need to get the difference between those two aspects. So the reorder level is dependent upon the lead time and the demand during the lead time. So we may look at some of the reasons as to why we may hold inventory. Why do we keep inventory? We have two approaches there. We have from the economics perspective. Why do we hold stock? And from here we have two aspects. There is an economist called Keynes. Of course, we went through the Keynesian theory and economics that dealt with, I think, unemployment, but had also his arguments as per the reasons as why we should hold stock. And he made some recommendations, which we call the motives, in regards to holding inventory. He also made some theories, as I spoke about. There are theories of unemployment, then theories of money demand. Those who did economics went through those. But what you have to understand is that when you have a question, or when the examiner gives you a question as to why we hold the stock, the first point you have to first give out. You first give out these points that were given out or that were recommended by this economist. Even if the points are very many, you start with these ones. They are 3 in number, but they are very many. But to be on a safer side, you always start with these that were advocated by this economist. Then the other reasons you can put as you want. So let's first focus on these 3 as they were advanced by the Keynes. Number 1, transaction motive. Which emphasizes the need to maintain inventory to facilitate smooth production and sales operation. In other words, is saying that whether you are only retaining stock, you need to maintain it to facilitate the sales process. In other words, we need to have more stock to ensure that at least we have business moving, the operations are moving. People come and buy items and we get cash for just being a transaction aspect, just to facilitate the sales. The second motive is precautionary motive, which necessitates holding inventory to guard against the risk of unpredictable changes. In other words, we look at the unforeseen circumstances in the forces of demand and supply. There are things we hold stock because we may actually have a higher demand, yet we don't actually have stock. So we look at things that come as unexpected. So that's what the precautionary motive is all about. Last motive is the speculative motive. Speculative motive. Once you know that the prices are going to increase, then you must buy more inventory. And when this goes down, because you buy them when you know that the prices are actually down, then if you are expecting that maybe they are going to increase, then you'll be able to have more sales, to get more revenue from selling more items that you bought cheaply. So you are speculating. You look at, maybe it may go up, then you say, let me buy because I'm anticipating that maybe the price may increase in the future. So if it goes down, then you say, I'm not going to buy because I'm expecting the price to be a bit lower than it is, so I will buy later. So we are just speculating. So on top of these three, there are others that can be added. One of them, to take advantage of bulk purchase discounts. To take advantage of bulk purchase discounts. As a deliberate investment policy, particularly in times of inflation or in the possible. So let's now look at inventory management modules or the inventory management techniques or methods. Now, we have some techniques that can help us to answer the major question which we had been asking ourselves at the beginning of how do we trade off between profitability and liquidity. How do we trade off between profitability and liquidity? So this is a question that we've been asking ourselves at the beginning, and we wanted to see how can we be able to trade off between profitability and liquidity. The most common tool or the most popular tool that we use to help us sort this trade-off is what we call the economic order quantity, which we abbreviate as EOQ. And that EOQ is the one that helps us to determine the optimal, quantity. It helps us to determine the optimal quantity of inventory. The business must have. So let's now look at the methods that we are going to be using. The different methods. We call them methods or modules or techniques of inventory management. These are the tools that we are going to use to help us manage our inventory, to help us trade off between profitability and liquidity. Now, we are going to first, of course, highlight them, then we look at one by one. Some of them are computational, others are theoretical in nature. Number one, we have the economic order quantity, the one we looked at, the economic order quantity, which we abbreviate as EOQ. Number two, we have total quality management. Total quality management, which we abbreviate as T2M. Number three, we have what we call just in time. Just in time, which we abbreviate as JIT. Number 4, we have period review. Period review system. And lastly, we have the order level system. So these are the tools that we are going to use to help us get to manage our inventory. So from these lists that we've provided here, the calculations are going to be on the economic order quantity and then the order level system, and the rest of the period review, the just in time, the total quality management, the rest we have to just understand what they mean, and that's all. So there is also one that I had skipped, the ABC. I had skipped the ABC method, the ABC system. So even this ABC system, it is theoretical, though there are some calculations, but they are not required. We don't need to do the computations, but they are computations. But we don't need to do, they are not required as per the financial management paper. So let's start by looking at one of each of these items, but get in mind that only the order level system and the economic order quantity are the ones that we have the computations. The rest are just for you to understand what they are meaning. So let's start off with economic order quantity. Economic order quantity, EOQ. Now, EOQ, I'm just going to abbreviate it as EOQ. Economic order quantity is a mathematical model that can be used to calculate the quantity of stock or of inventory, the quantity of stock to order from a supplier. Each time an order is made. That is definition wise. It's a mathematical model that can be used to calculate the total quantity of stock to order from a supplier each time an order is made. That what is that quantity of inventory that we are supposed to order every time when we are ordering stock. So that uniform amount that you are going to be ordering every time you are going to be making an order is what we call the economic order quantity. So it is a quantity and we compute it to help us know which we are supposed to incur. So as a business, we don't simply just order, but we order the ideal. Remember, all the issues is about the ideal. We order the ideal, or what we call the optimal the optimal amount or the optimal quantity. The optimal amount that is obtained using this EOQ model. And the reason why we order the optimal amount that we determine using the economic order quantity, so that is that we, when it comes to when it comes to the usage, using using it, so that, because now you are going to be ordering this specific amount, and when you start using that amount that you have ordered, and when it goes down before you reach the what we call the buffer stock, or what we refer to as the safety stock or the minimum stock, before you reach that, this ideal quantity is the one that we are going to be using, but we shouldn't reach the buffer stock. In other words, we are going to use it, and when it goes down before reaching to this buffer stock, we make sure all this buffer, the minimum zone, then we make sure that another order of the same quantity is ordered. Remember, we order at the reorder level. So before you reach the buffer stock, you have to make sure that you make another order, but the order should be the optimal amount of quantity, and that optimal amount can only be determined by using the economic order quantity. So for examination purposes, we need to be careful, because at times the examiner asks the question in stages. So we need to know how to calculate each component within the formula for EOQ, the formula for economic order quantity. And we have to note that the main aim of the model is to identify the order quantity of an item of inventory that will minimize the total cost of holding and total cost of ordering of stock. In other words, the whole idea is all about minimizing total cost of holding and then total cost of ordering stock. In other words, we are minimizing total holding costs and also the total ordering cost. In other words, the point here is that if you keep on ordering, and ordering the stock, so ordering this stock that will come in, will be put in the store. When you make an order, you are going to store whatever you have ordered, and by you putting what you have ordered in the store, it means we are incurring costs. First of all, we are incurring cost of ordering the stock, and at the same time the cost of storing the stock. And we had already seen that in the store there are already costs associated in that perspective. For example, the security costs, CCTV cameras, burglary proofs. So you find that those are going to be costs the moment you start to keep the store full with the either raw materials or finished products that you have produced. Now, the essence of this model, the EOQ model, is that when an order is placed, we can be able to minimize the costs involved. The economic order quantity will only give you an optimal amount. It will only give you an optimal quantity to order that will allow you to minimize the costs associated with that order that you have placed. So, for better understanding, let's try to look at all the steps that form the economic order quantity formula. So let's look at all the things that are going to be involved within the economic order quantity formula before we look at the economic order quantity itself. So whichever that I'm going to talk about is going to be one of the components that is going to appear in the economic order quantity formula. First of all, we talked about holding costs. Holding costs. So the model assumes that it costs a certain amount to hold a unit of inventory for maybe a given period of time. It could be a year, it could be a month, it could be a week. So the model assumes that it costs a certain amount of money to hold a given unit of inventory for a given period of time. Therefore, we need to take care of, we need to be mindful, we need to take a note of these holding costs, since it's going to be costs that we are going to be incurring in a year. But the examiner may give you, maybe it is in per month, per week, so we have to adjust it accordingly, but always the holding cost is per annum. So we can adjust it. If they give it to you in per month, then you can adjust it accordingly to get the annual figure. So we adjust we adjust it accordingly, since the formula computes it per annum. Now, in other words, holding cost is that cost the company will incur, is that cost the company will incur to keep the inventory after purchasing, to keep the inventory after purchasing. After purchasing until it's fully used up. So we keep this inventory. Remember, when they buy in bulk amounts. So they have to keep it somewhere, and they will be picking from there whenever they are doing their production process. So by keeping raw materials or finished products in a store, we are incurring costs. We are incurring costs of people who come and clean there to see that our materials or our finished products are not going to be contaminated with certain kind of things that may be mixed up. Therefore, as an average level of inventory increases, it means even the annual holding costs, the total annual holding costs incurred will also increase. In other words, if, for example, if 2 is your quantity that you have ordered, quantity ordered, Then the annual holding cost would be calculated as follows. We shall be using the formula. It will be the holding cost per unit times the average inventory, or average stock. So we can abbreviate this holding cost as HC times the average inventory. Average inventory is Q, which is our quantity. We said the quantity is Q, divided by 2 to get the average. So alongside this, there is what we call the ordering costs, which are costs associated with making an order. In other words, the order of making this quantity Q. So let's try maybe to explain more about ordering costs. But it comes, you can't hold something you have not bought. And there is no way you are going to buy something before making an order for it. So alongside these holding costs, there is what we call the ordering costs. Ordering costs. Ordering costs. Now, the model assumes that a fixed cost is incurred every time an order is placed. In other words, we incur a fixed cost every time an order is placed. In other words, the order we place, we incur a fixed cost. That's the meaning. Therefore, as the order quantity increases, there is going to be a fall in the number of orders required, which reduces the total ordering costs. Because as you increase the quantity you are ordering, then it means there is going to be a fall in the number of orders that you are going to be making or that are going to be required, which eventually reduces the total ordering costs. Now, if for example if D is your annual demand, the annual expected maybe demand or production. So if D is your annual expected sales, let's say maybe sales or production demand, then the annual holding costs, the annual ordering costs will be the order costs per order, not per unit, but this one is per order, times the number of orders, per annum. How many orders are we going to be buying in a year? So meaning the formula is going to be ordering cost, we can call it OC, ordering cost times the number of orders. Now, for you to get the number of orders, it's going to be the demand, the annual demand, D, divided by the quantity you are going to order. That's the only way you will be able to get the number of orders per annum. If let's say the annual demand is 10 tons, then if at all every time the quantity you order, every time maybe you order 5 units or 5 tons, you'll find that in a year you will be ordering 10, which is the annual demand, divided by the number of tons that you order every time you make an order. So it will give you 2 times, meaning you'll make 2 orders in a year. That's what we are meaning. That's why we get D over Q. This is the annual demand and this is the quantity ordered every time we order. So the number of orders per annum will always be the annual demand divided by the quantity you order each time you make or each time you put in an order. For example, if let's say you are ordering, let's say you may find maybe someone is ordering 10,000 kgs of sugar. That's what you order in a year. But every time you make an order, because you can't stock the whole 10,000 at once, maybe you stock it in January and you be with it up to December. Remember, these things expire. So to avoid that, you keep ordering what you can, because if you bring all this, it's going to make sure that you utilize a lot of space. You'll be paying rent for nothing. You better order something that can fit in your room. If maybe you have a room that is going to only accommodate 1,000, and maybe that 1,000 is the quantity you can actually order, then we can say that 1,000 we divide by 1,000 kgs, meaning that you'll be ordering 10 times. So the number of times or the number of orders you are going to be making, they are the ones that we do. And I hope you have gotten that. So the examiner may ask you for the total cost. The examiner can ask you for the total cost incurred. And this will be given by the formula total cost. They may ask you for the total costs. Total cost will be given by ordering cost, which is the total ordering cost. Ordering cost plus the holding costs. So you get the total ordering cost plus the holding cost. That will give you the total cost that you incurred in holding that stock. So the economic order quantity has assumptions which are highly examinable. And when they ask you for the assumptions, you give them the way they were given to you by the person who developed that model. Whichever model, whichever theory, as long as they are asking for assumptions, you state them the way they were given by the person who developed them. You don't explain. Now, because when the examiner is asking for the assumptions, most of the times he's asking for assumptions, then part B, he asks you for the limitations, or the challenges, or the criticisms of the model. So when the examiner asks you for the limitations, you make sure you just criticize the limitations. You just oppose the assumptions that were given by the model, and that's where you explain. So for the assumptions of EOQ, you just give them like the way they are. Then when you are asked for the limitations, those ones you just oppose them, and that's where you make an explanation. And I hope you have got that. So let's look at some of the assumptions. Assumptions of EOQ. I said I'm going to be using EOQ, but EOQ I'm meaning economic order quantity. So assumption number one, we just give them like the way they are. There are no bulk purchase discounts. No bulk purchase discounts. In other words, making the order to be of large size or large quantities doesn't guarantee you to qualify for a discount. I'm explaining because I'm not going to give you the limitations. So if you are giving a limitation, you criticize this, because most of the times in the real world, we always get discounts as long as we buy in bulky quantities, and you are done. Then annual demand. Annual demand for the stock items is constant. Throughout the year. This is a lie, because you can't tell me that today we needed 10,000 kgs of raw materials, even next month we shall need the same. Because what if now we don't get customers? What if we get more customers? So that's how you are going to be able to criticize, and that's where you are going to be explaining if you talk about the limitations. The other, they are saying that order time, the order lead time, is predictable. So order time being predictable, the implication is that the delivery for the new order is always timed. Which is a lie, because some transactions, some orders may actually have fluctuating lead time. In other words, there may be some difficulties that maybe the supplier got on the way when they are delivering, and you find they are not delivering in time. But these guys, they are saying you can actually predict the lead time. Sometimes you can't. The last one, holding cost per unit and the ordering cost per unit are known. They are assuming that the cost of holding stock and the cost of ordering stock, they are known with certain. In other words, they are known with certainty. You can't, that it is very easy for you to predict it, and you're predicting something that is true, which is a lie. So they are saying that the holding cost and ordering cost per unit, ordering costs, or the cost per order are known with certainty. So those are the assumptions, but be able to get the limitations, because I've been explaining. Let's now look at a summary. I just want to summarize of ordering costs. What are things that are within the ordering costs? Ordering costs, one of the item we have requisition. Purchase requisition. That this, when you are purchasing, you have to first make a requisition, because there are those requisition costs that you are going to be incurring. Maybe you are printing documents, there is a cost. There is order placing. Some people make orders online. There is that cost of internet you are exposed to. It is a cost. We have clerical costs and staff. We have to get people who are going to help us generate these documents, the purchase requisition note, the whatever. There is receiving, the people who are going to be receiving these goods, we pay them. Receiving, inspection, and storing costs. These are all costs that are within ordering. We have also transportation. So these are some of the costs that you can look at and know that these are actually going to be incurred when I'm ordering. Now, we want to look at what are some of those costs that we are going to be incurring at holding. We want to look at the summary of holding costs. Sometimes we call them holding costs or carrying costs. So we want to look at the summary of those costs, the warehousing, all the storage costs, even clerical costs and staff, handling, auditing and stock taking, insurance, damage. There are very many. So let's look at now the ordering, the economic order quantity formula. Economic order quantity formula. This will only give you the ideal or the optimum quantity you can order. So we said EOQ will be equaling to the square root of 2 OC. OC we abbreviated as ordering cost times D, and we abbreviated D as our demand, over HC, which we abbreviated as holding costs or the carrying costs. So where that's the formula, where OC equal to the cost per order, or what we call the ordering cost. HC equals the holding cost per unit, cost per order, not per unit but per order. Then D is our annual demand. It is always per annum. So if they give in math, you convert. So annual demand for stock. Now, that's the formula that we are going to use to compute the ideal stock that we need to order every time we make an order. Now, as a finance manager, EOQ helps you to manage costs by getting the ideal or the optimum order quantity that minimizes the sum of the annual ordering costs and the annual holding costs. However, if the examiner asks you to explain the concept of economic order quantity, we can explain it in two ways. We can explain it using the algebra or the graphical illustration. And it is always better to explain it using the graphical method than the calculus or the algebra. Because the algebra is that dy dx. So if you are required to explain the concept, of EOQ, we use two methods. You can use the calculation, that we talked about, or you do the graphing. So we want to determine the EOQ using the graphing. So we are going basically to use the graphical method. So it is using graphical method. So let's now draw our graph. We always have quantity here. We have the costs. So we first draw the carrying costs. The carrying cost or the holding cost, they increase as per the level of, it is always a straight line moving from 0. Then we draw the ordering costs. They keep on reducing, so it means they are going to be moving like this. Then we have now the total costs which are above. These are carrying costs. Carrying costs, these are total costs. Then these are ordering costs. But we said the carrying cost is the same as holding costs. So where these two lines meet, the carrying costs and the ordering cost, where they meet is where we shall have our EOQ here. Because that will be the quantity that will minimize, so we can move towards the line for the total cost. Because total cost, we said we are trying to minimize. It is the carrying and the ordering. So the EOQ is a concept that is used to determine the ideal or the optimal quantity of stock that you will always need whenever you place an order. As you have seen, we have identified it and it's here. The quantity here is that quantity that we are going to be using whenever we are placing an order. So this quantity here is the one that we are going to be meeting, but we get it from the point where the carrying costs are meeting the ordering cost from this point, the equilibrium point there. Now, you will put the costs Of course, you put the costs on the y-axis as you are drawing. Then you put the number of units, because you may have this and you are supposed to draw it on a graph. If you have a number and you want to draw it on the graph, you put the costs on the y-axis. This is the y-axis, and this is the x-axis. This is y-axis. So, in other words, this graph is a graph of costs against units you are going to order. And we are saying that each time you place an order, since we keep ordering throughout the year, once you put in an order for 1 unit, you will incur a given ordering cost. And as you increase the number of units, the cost will keep on reducing, because the ordering cost is fixed. But the total carrying cost will keep on increasing. That's why you are seeing that the carrying costs, for them, they keep on increasing. As you increase the output, the output this side, you find that even these are going to be going up. As you increase, they are going up. But for the units, as you keep on ordering, we started from here. When you're ordering small, the costs are less. But when you keep on ordering more units here, you'll find that you are incurring reduced costs. So that's the implication. So therefore, as a finance manager, you will be interested in this total cost here. And it is the combination of ordering costs and the ordering costs and the carrying cost. That's why where this line stops, we just proceed to determine what is the cost here. Meaning the value that will be here will be our total cost. So it will be the combination of ordering and holding cost. But as the units ordered keep on increasing, it will make the total costs to keep on reducing to a certain point. And it is that point which we call the optimal quantity. So you must order, it is that optimal quantity you must order in order to minimize the total costs. Remember here we've taken the minimum. This is like a V. We've taken the minimum point. This is the minimum point. Otherwise, we would have picked the values from this side and we'll take it to this side. But we are picking it from the minimum. So we are trying to reduce the total cost to keep them reduced at least to be on a minimum level. Otherwise, beyond this point, the costs will keep on increasing. You are seeing they are increasing as the units keep on increasing. So that's what I wanted to explain graphically. Let's now look at dealing with quantity discounts. If at all you are buying, because remember, EOQ was suggesting that we don't actually have discounts. But we want to look at situations where we are buying in bulk and they are giving you discounts. So, dealing with quantity discount. With quantity discounts. So, because the model assumes that there are no discounts, the EOQ model assumes there are no discounts. But at times, in the everyday life, discounts are actually available to customers who buy in bulky numbers. If you have discounts in your business, maybe you are buying raw materials and they are giving you trade discounts or cash discounts, whichever discount that they have given you. So if you have the discounts, then we can still use the economic order quantity to deal with those discounts. In other words, once we have got the discount, we can also use the economic order quantity formula to get the optimal quantity to order, even though the model doesn't entertain the discounts on the purchase price. So if you are to do that, we follow some steps. So we have steps to be followed. Steps to be followed. To be followed in case of discounts using EOQ. We are still using EOQ and we want to see how we can do this. Now, step number 1 is for you to calculate the EOQ, economic order quantity, ignoring the discounts. In other words, here we first assume that there are no discounts. So we first assume that there are no discounts and we compute the EOQ in a normal way. Step number 2, we now look at the EOQ we've got. If the EOQ that we have computed in part A, if the EOQ in part A, in part 1, is below the quantity, qualifying for a discount, then you calculate the total annual inventory costs arising from using EOQ. We shall see that. Then number 3, calculate the total annual inventory costs using the order quantity. The order quantity required to obtain each discount. And number 4, we repeat for all. We repeat the same for all the discount levels, because they may give you a lot of discount levels. They may tell you that if you buy 0 to 1,000 tons or 1,000 kgs, you get maybe 10%. If you are to buy maybe 1,000 kgs, between 1,000 to maybe 3,000 kgs, you qualify maybe for 15%. They may also give you that if you buy above 3,000 kgs, you qualify for 20%. So these are the discount levels I'm talking about. But if they give you only one discount level, then each of these discount levels, you go through these same steps. But step number 2 is the one that is more critical. You have to compare the EOQ with these ranges they have given you to see if at all the EOQ is below these quantities that are going to help you qualify for a discount. And if it is below, then we go ahead and compute the cost. But if it is above, then we just take the EOQ. So we are going to have maybe a simulation. That's when we will be able to understand. We'll be able to understand it better. So let's have a simulation. Simulation. We have KC Group Limited. Estimates its demand. Estimates its demand for product Y is 24,300 units per year. Full stop. It has holding costs of shillings 675 per unit. Full stop. Comma. It also has the order costs. The order costs are shillings 5,000. And each unit costs shillings 2,400 to purchase. Full stop. A discount, they are continuing, a discount of 1%. A discount of 1% is available on orders of 700 or more, and a discount of 1.5% is available for order quantity order quantities of 1,000 units or more. Full stop. Determine the least cost option. Full stop. They want us to determine the least cost option. So let's look at the solution. Now they have given us annual demand D, which is the annual demand, as 24,300. This is per year, per annum. They have also given us HC, which is the holding costs. They have given us holding costs as shilling 675 per unit. They have given us ordering cost, OC, ordering costs as 5,000 per unit. They have also given us the purchase costs, PC, which is 2,400 shillings per unit. So we said step one, our step one is always to compute EOQ. EOQ without considering the discounts. So we get the EOQ, which is 2 into OC times D over HC. So we substitute in the values. EOQ is square root of 2 times 5,000, then times 24,300 over 675 shillings. So when you do that, you'll be getting EOQ as 600. These are units. Now, the EOQ without discounts. This is without discounts. Is 600 units. Then step 2, our step 2, we said we have to calculate. We need to calculate the total annual inventory costs. Inventory costs, if at all there is a condition, if the EOQ is below the quantity qualifying for the discount. So we need now to look at our EOQ is 600 units we've got. Now, since the EOQ is 600 units, which is below the quantity qualifying for the discount, because the quantity qualifying for the discount is 700. They started from 700 units. 700 units and above, then 1,000 units and above. Meaning this 600 is already below the 700. But now they are telling us If you have confirmed that it is below, the EOQ is below, without discount is below for the quantity qualifying for the discount, then you calculate the total annual inventory cost. Total annual inventory cost is different from the total cost. The difference is the total annual inventory cost includes the purchase cost. Remember, the total cost was just the ordering cost plus the holding cost. But here, if they tell you to total annual inventory cost, they are telling you add purchase cost plus holding cost, then plus the ordering. So that's what we are going to do. But there is that condition is very important. You have to first see if at all it is below. So we start now computing. We need now to compute the total annual inventory costs. And this is going to be in different, we have to first look at the annual purchase. The annual purchase cost, which is the annual demand times the purchase price. They gave us all these. This is 24,300 times the 2,400. So this is going to be 58,320,000 shillings. That is the first one. Then we have to add, because we are going to add, this one is we are supposed to add all these two items, these three. Then we look at the annual we do now the annual ordering costs. We know that ordering cost, it is actually the quantity, the annual demand, which is 24,300, divided by the EOQ, which is the quantity Q, which is 600, times the ordering cost per unit, which is 5,000. So when you do that, when you substitute into your calculator, you find that these ordering costs are actually going to be the annual ordering costs are going to be 202,500 shillings. So we compute the annual holding. We now compute the annual holding costs. The annual holding cost, we said it is going to be the EOQ divided by 2. That is average inventory, which is the EOQ, which is 600, divided by 2, then multiply by the ordering cost per unit, which is 675. When you do that, you'll have 202,500. It is the same figure, shillings. Now we get what we call the one they have asked us, the total annual inventory cost, which is the purchase cost, of course, the annual purchase cost plus the annual ordering costs plus the annual holding costs. So we add. The first value was 58,320,000 plus the 202,500 plus the 202,500. So when you add all those, you will be able to get the cost as 58,725,000 shillings. That is the total annual. This is at the 700, because we compared only the 700 discount level. Now, when you are done, you go to step 3. The step 3 is we calculate the total annual inventory cost at the minimum. We take the minimum order quantity required to obtain each bulk discount. If they have given you a discount bracket of, let's say, from 700 to 1,000, you take the minimum, which is 700. Others, they tell you add this and this. That's wrong. You take the minimum. Remember, what we are trying to look at, we are trying to get the minimum cost. So you can't be looking for the minimum cost and then you take the higher figure, or you take the average. You will not be making anything. We are trying to look at the minimum cost that we can incur. So the 700 is going to be our bare minimum, because there are 2 percentages. Here we get 1%, and the other one from 1,000 to 1,000, then above. 1,000 plus is giving you 1.5%. So on this one, we shall take the 1,000. Of course, this one, it means this one doesn't reach 1,000. It is maybe 999. Then 1,000 will be this side, because they have not told us that if you buy 700 or equal to 1,000, you get 1%. So you get those kind of stuff, or equal to. That is me, I'm not teaching mathematics here, but you just need to understand it. So we start computing. The minimum we have understood it is 700, and at this time we have 700 units. So we have to go ahead and compute the same. We have gotten, now this minimum is going to be our Q, which is the quantity Q, meaning it is going to be 700. Where we've been substituting the EOQ, we are going to substitute in this, and we repeat the same thing that we did in step 2. We go through, we get the annual purchase cost, we get the annual holding cost, the annual ordering cost, we sum them up. Then after doing that, we do the same for the other inventory level. Then we shall see how we make a decision. So the minimum is 700. So it will be the 700 units. That's what we are going to use as our quantity. So we will be getting a 1% discount. But this discount is on the purchase price. So we start computing when the quantity is 700 units. So we get the annual purchase cost. We said we gave the formula, we don't repeat, we just take the 2,300 is the annual demand times the cost per unit, which is 2,400. But these guys, they gave us a discount of 1%. So it will be 100 minus 1%. That will give you 99%. So this one will multiply by 99%. Or you can first compute this. After getting the answer, you multiply by 1%, then you less from the answer. So this is going to give you 57,736,800 shillings. Then we compute the annual ordering costs. Annual ordering costs, we gave the formula. It is the annual demand divided by the EOQ to get the number of orders, which is 24,300 divided by the 700. Now we are taking the quantity as 700 times the 5,000, which is the cost per order. This will give you 173,571 shillings. Then we do the last one, which is the annual holding cost. Annual holding cost, we do the same. It's going to be the EOQ, which is 700, the quantity divided by 2 to give us the average inventory times the cost, the holding cost per unit, which is 675. This is going to give you 236,250 shillings. So we add these three. We add this plus this, then plus this to get the total annual inventory cost. So we need the total annual inventory cost, which is, so this is going to be 57,736,800 shillings plus the 571 plus 236,250. So this will give you 58,146,621 shillings. So that's the value. So we now go to the other inventory level. We now look at 1,000, because they told us if you buy more than 1,000 units or more, you qualify for 1.5%. So we do the same thing. We compute the annual, because we have seen that 1,000 is our minimum. So we get the annual purchase cost, which is the 24,300 times the 2,400 times, now this is 100 minus 1.5. So that will give you 98.5%. 98.5%. That is after we have deducted So times 98.5%. We multiply by what we have left because the other discount is what we earn. This is what we are paying. So this is going to be 57,445,200 shillings. Then we do the annual ordering costs. Annual ordering costs is going to be the annual demand, which is 24,300 divided by 1,000, which is the quantity, times the price, which is 5,000, and this is going to give us 121,500 shillings. So we do the last one, which is the annual holding costs, annual holding or carrying costs, which is the average demand, which is 1,000 divided by 2 times the 675, and this will give you 337,500 shillings. So we add these two. We add this plus this plus this to get our total annual inventory cost. Total annual inventory cost. So we add the 57,445,200 plus the 121,500 plus the 337,500, and this will give you 57,904,200. Now, after computing, then we need to make a decision. This one we can call it advice or comment. We need to make a decision. Now, we make the decision on which one to take as our EOQ. And here we will look for the one which incurs the least. In other words, we take the one where we are incurring the least cost. In other words, the least total cost. So the least total inventory, total annual inventory cost is the one that we take. And we can see that from the above, the smallest is this one, which is 57,904,200 shillings. In other words, this amount was brought by the 1,000 units, meaning these 1,000 units are going to be our EOQ. So the EOQ will be 1,000 units because these are the units that are going to give us the least costs. Now you need to note, remember we've been computing because the EOQ was below the quantity qualifying for discount, qualifying for a discount. Now, what if now this EOQ that we computed, the EOQ without discount, is greater than the quantity qualifying for a discount, what do we do? Now, if you find that the EOQ is higher than those quantity discounts, all those quantity figures that help us to qualify for a discount, then we will consider this EOQ. Meaning we just take this EOQ. If it is 600, we shall say that it is 600 units, the EOQ, that will be the optimal quantity. Because remember, we are not looking at the cost, but we are looking at the quantity that minimizes the cost. So we only take this and we ignore those discounts. Because if this one is higher than this, then it means this one will be the one that is going to give us the least or the lower cost. However, there are some scenarios. There are issues when we have something to do with uncertainties. And when someone has uncertainties, it means you are not going to be sure of the right amount to order. In other words, the annual demand, you can't estimate it. The annual demand will be hard for you to estimate. Then if it happens that way, what should you, like, how are you going to handle that situation? When you can't determine the annual demand, like you can't determine it with certainty. So EOQ, let's look at the EOQ under the condition of uncertain demand. For example, I can give you an example. If let's say you're a business and this business is maybe dealing in soap, either bath, washing soap or whatever, but you find maybe the customer wants 10 boxes, but according to how you are going to transport these boxes, you may have damages. So if you are going to have damages on the way, maybe these bars of soap, they are going to be broken down into smaller pieces, whereby the customer is going to refuse them. What you do, if the customer has ordered for 10, because you are not sure whether you reach the customer's destination when this soap is still in good condition, you can add extra. Maybe let me go with 15 boxes, so that if some are default, then the customer can actually pick from the 14 to pick the 10. So that's the kind of scenario that I'm trying to reason out. So if the demand is uncertain, because there are instances where, if let's say you are buying raw materials, but you don't know, because of the quality, some of these raw materials you may order less and you don't fulfill the customer orders. Because you have bought less materials, it means you have gotten less output. So if you are not sure that if I put in these 10,000 tons of raw materials, I'm getting maybe 5,000 tons of output, then you make, what do we do? Because you are going to be ordering. It would be awkward if I told you order 10,000 kgs of, let's say, any concentrate, but you find that you are projected that the 10,000 kgs are going to help you get maybe 900 kgs of output. And this is what the customers had ordered, and the customer had already paid. But you find that when you bring this 100 kgs, if this is your EOQ, you will find that this item, maybe it was unable to give you this, and it only gave you maybe 800. The question is, where are you going to get the other 100? So if you are not sure that this raw material I'm ordering may not actually give me the desired output, you order more. But ordering more increases costs. So want to see how do we deal with uncertainties. So if the demand is not known, then we should use what we call safety stock. We talked about safety stock. The safety stock approach is very important. Is the one that is going to help us, to determine the optimal level, inventory level that we should order to be able to understand the concept. So for us to be able to understand these concepts, we need to make sure that we have a practical simulation. But what we have to use is what we call the safety stock. So let's look at a simulation. KK soap factory. The annual demand for soap is 5,000 packs. Full stop. The cost of placing an order for raw materials for one is equivalent to shillings 12,000. Full stop. The cost of holding one pack is shillings 4,000. Full stop. It's estimated that another 500 packs are needed to cater for uncertainties in the delivery of soap to the customer, Full stop. Required determine the optimal level of soap that should be maintained by the business in order to meet the demand of the customer, the demand of its customers. So let's look at the solution. How best can you approach this? This question gives us an extra 500 packs. Extra 500 packs. On top of the demand of 5,000 packs, because they are saying this is their annual demand, but on top of that they are getting extra packs of 500. So the demanded units are 5,000, but we have an extra 500 packs. This alone implies that these 500 packs, the extra, will act as a safety stock. Since the actual demand is not known, otherwise, if the demand was surely known, the extra wouldn't be necessary. So the question is how to determine the optimal stock. They have given us the demand. Demand is 5,000. They have given us OC, all the ordering costs, as 12,000. They have also given us holding costs as 4,000. The safety stock, that is the extra. The safety stock they have given us 500 packs. So with the safety stock, the optimal level of inventory becomes, if you have safety stock, then the optimal level changes. It will be equaling to the EOQ plus the safety stock. Safety stock. So we need to compute the EOQ. This will be the EOQ. We put in, it is 2 OQ times D over HC plus the safety stock. So when we substitute into those formulas, we will see that we have 2 times 12,000 times the 5,000 divided by the 4,000, all of this and the square root, plus the 500 packs, and this will give you 673.2 packs. Now, we need to explain something small here. You see this point, there is no way you can say, me with the customer, we have a bar of soap which is in a point. But that point is very important, because if you don't take it, it will be a problem. In other words, if you try to round off, because there is no bar of soap which is half. So what the other person will do will say that we are going to take 674. This will be wrong, because if you take an extra, it means you have added, you have increased the cost. Yet our main issue is to make sure that we balance the stock. Here we don't round off. That's what I wanted to. Of course, it is approximately. You see this, the 73.2. The answer is supposed to remain as it is. But mathematically, it is the same as someone saying, since we don't have, because this, we can't say we can round it to 4. This one, these 3, we can't round it to 4. But it would be better if we round it to 4 because there is no half a bar of soap. It would make sense if I told you round it off. But the challenge with this, if you just give 6, 7, 3, and this one would be more wrong than at least this one. Because for this one, now what if they are not enough? Because we computed and we've gotten this decimal, it means if you take the 673, they won't be enough. It would be better if I told you just take the 674. But for exam purposes, even if you just leave it this side with the point, make sure you leave the rounding figure. Because this rounding figure is going to give you stories, because the demand is already uncertain. If you bring in something you are reducing, you rather increase it. When you are commenting, what I'm telling you, I'm just trying to give you a broader picture of how you can comment if at all they tell you to advise. So that's what you should be careful with these points if at all the demand is already uncertain. So this safety stock is the same as buffer stock, the same as the minimum. We looked at that already. So we are done with that. Let's now look at other. That's what I wanted to share about EOQ. Let's look at other inventory control systems. Or methods. We've done EOQ. Remember, we listed them, and there were very many. So these other ones, they don't have, some of them don't have more computations. We said we have only 2 which has some computations. So let's look at total quality management. It is abbreviated as TQM, total quality management. Total quality management is all about quality. For it, it is all about quality. And when we mean quality, it's all about quality and no wastages. In other words, we waste nothing. There is no wastages of resources. We use everything at 100%, and we are producing even the items at 100%. So everything is good within this method or this system. And it is more of a max. This is what you did in your tuty. It's more of a max, a max approach. We looked at it in our MDC. Max approach. In other words, everything is at maximum. The people, they are at their maximum usage. In other words, where we keep everything at maximum and there is zero tolerance on unnecessary inventory costs. Costs which are not necessary, they are not tolerated. So when they are meeting their demand, or most of the times they meet their demand, all the time they meet their demand, because everything is working perfectly. So this method implies that everything that we are going to be looking at is going to be perfect. All the resources are going to be available. So this method only applies to developed countries. And in most cases for the companies that specialize in certain products with higher expertise, hence producing everything efficiently. So most of these approaches that don't involve in computation, they are just all about for you, they just require the student to understand what they mean. And even on this one, the other thing that they can add is for the merits. They just need you to understand the merits and the demerits of this. So those you can check out in the workbook and you read through them. But just know everything is perfect in this. Even the stuff, there is no wastage, no abnormal losses, nothing. Everything is perfect. The other is just in time. Just in time, which referred to as the JIT system. The just-in-time inventory control system. Just-in-time inventory control system, this is almost the same as total quality management. It is almost the same. It's almost the same approach. But this has some assumptions that we can try to understand. The just-in-time has some assumptions. Now, the aim is to set up a system where suppliers deliver the exact quantities to the manufacturing process at the exact time it's required and on the exact quantities. If you're a supplier and I tell you supply for me 10 kgs, 100 kgs of let's say sugar, and you're supposed to supply it, I need it on Tuesday, and you're supposed to bring it at noon. These conditions, they are supposed to be met. You need it in the same quantities as I need, on the same date that I need it, on the same time that I've requested the order. So everything is supposed to be catered for. In other words, no wastage. And it is only done when we have received customer orders. In other words, the moment you receive the customer orders, you go to the supplier, you ask for the raw materials. And when the supplier is supposed to submit the raw materials as and when you need them. And he brings those same materials, meaning you are not going to keep any inventory. Nothing. Now we need to look at, there are some conditions on this. What are conditions? Conditions necessary for the success of JIT system. Because they are conditions, if you don't meet them, then you will not be able to use JIT system. One, efficient transport system, there are not supposed to be any delays that I'm facing jam and I'm facing mechanical issues. Transport system is supposed to be very important at efficiency. So there is close relationship with the supplier, with the key suppliers. In other words, these suppliers are supposed to be reliable. When I give them a call, they are supposed to deliver at that same time. Then very strict contracts with penalties. In case delivery is not made. Is not made on time. In other words, when you have to be, the suppliers are supposed to be readily available, and if they don't deliver at the same time you needed it, you charge them penalty. They pay. The other is the quality standard should be clearly defined when you are making your order. Quality standard is clearly defined. Quality standard is clearly defined. The suppliers are supposed to be located geographically near to the organization, close to suppliers, that you are near. So these conditions of JIT, most of the times they are used also in developed countries like Japan, Germany, China, and others. So let's look at the other method, is ABC system. It is commonly known as Pareto analysis. It was named after the person who brought that system, the ABC. Now, this is mainly used in many management studies. It's mainly used in management studies. Even when you are implementing some work plans, implementation of work plans. And here, Pareto analysis says, especially in managing the work plans, in that you get 20%. You get 20% of the activities. You get 20% of the activities that will give you 80% of the results you need. In other words, you focus on only 20% of those activities, and those activities should be able to give you 80% of your desired results, or of the results you need. So the 20% of, let's say, sales, 20% of sales items, they are giving you, maybe they are generating 80% of the sales revenue. This is what we are talking about if you put it in a mathematical aspect. So this same principle is used in inventory management, whereby you look at the categories of products that you are going to produce or that you are going to process. And you also look at the stock volumes involved. For example, if product category A, let's say product category A requires 'requires' a stock volume of 20%, but will give you 80% of stock value. Then what you need to do with this, you need to monitor this one very closely. You monitor it very closely because it is very important. You monitor it very closely. So you closely monitor that stock and carefully monitor that particular item. So this is the first category. The second category is if, let's say, if you have got product category B, which requires 30% stock volume or stock items, but it will give you only 15% of stock value. Then this one might require a regular review. A regular review, maybe you are doing the review maybe after 1 week. At least after 1 week you check on it. The last one is if, let's say, if you have product category C, that requires 50% of the stock volume, but will give you only 5% of the stock value. It will give you only 5% of the stock value or the result, then it doesn't even need, it doesn't require you, it doesn't require regular monitoring and checking. Thus, when you're using Pareto analysis, category A might be a particular, this category, product category A will be, might be a product that you have particular interest, because if you are going to use 20% of the stock volume and they will yield 80% of your stock value, then that particular item might require close and tight controls. So you look at the products and you also look at their priorities basing on the results. There are those that are going to require less raw materials, but they are going to contribute a lot. So we can maybe arrange this in a table. Category, then stock volume, then stock value, then a comment or advice. So you can have a summary. This is product A, product B, product C. So for product A, it is requiring, this is in percentage, even this is in percentage. So project A requires only 20%, but it will give you stock value of 80%, meaning you only put in 20% of the items, but it gives you 80% of the result. So this one will require 30, but it is only going to give you 15%. So this one is for 50, but it is only providing 5%. So you see, the comment here is that this one, they require cross day-to-day control. In other words, you have to keep on checking these products every day. These ones, category B, will only require regular review. You don't review it all the time, because at the end of the day, it's not all that providing something that is where we can put more emphasis. Then the last one, here we just need a frequent review. You can actually review or you cannot review them, because at the end of the day, you are using 50% of the inventory items, but you are only getting 5%. If these are inputs, you are using 50% of the inputs, but they are only providing you 5% of the outputs. Then this one you don't need even to monitor. So that's what we are talking about whenever we are referring to Pareto analysis. As I said, there are some computations you can find when you have to draw a graph, something that looks like a lens curve. If you know how to draw a lens curve, even when you look at the computations that we do here, they are the same like those of drawing a Lorenz curve. But we don't need it here for financial management. The other system is the reorder level system. Now, for you to understand the reorder level system, you need to first do at least a past paper number. But before we do that, we have some formulas. Just getting the formulas that are within. Then you have to also to look at the advantages and disadvantages I told you. Maybe we can first have a simulation. Then the simulation that we are going to have is going to lead us to providing formulas. So the simulation, it says the following data relates to a particular stock farm located, let's say located in Hoima district, full stop. They have given us normal usage as 110 per day. They have given us minimum usage as 50 per day. They have given us maximum usage as 140 per day. They have also given us lead time, both the minimum and the maximum is 25 to 30 days. Meaning this is the minimum, this is the maximum. Then they have given us economic order quantity as 5,000. Economic order quantity of 5,000. The required, they are saying using the above information, using the above data, compute the following control levels. Part A, we have reorder level. Part 2, we have maximum level. Part 3, Roman number 3, we have minimum. Minimum level. I'm not going to compute it, but let me give you the answers. This is 4200 units. The answers here is 7950 units. Then the one here answer is 1175 units. So you can have as a simulation, but after getting that, You can also try out question 2. Question 2. Can try out question 2, August 2018. So let me give you now the formulas. Because these are just formulas, it's just you to plug in those formulas and you get the answers. So the order level is given by the maximum usage. They can call it maximum usage, maximum consumption. They mean the same thing. Maximum usage times maximum read time. Remember we said the order level is that level at which another order is supposed to be placed. So we always use the maximum. You see, this is maximum, 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 because we don't want to understate our reorder level. We want to use the maximum usage and the maximum read time. When you multiply, it will give you the number of units that when you reach on those units, that's the maximum we can consume. We don't take the minimum, because if you take the minimum, then you will reach on the safety stock. If you use the minimum usage times the minimum read time, you will be understating your order level, because you are going to reach at a point whereby the stock will be done by the time the other stock comes in, when you find we have already finished the safety stock. The other is the minimum level. Minimum level is given by the reorder level, meaning if you get the first one wrong, even this one would be wrong, minus average usage. Average usage times the average lead time. Then we have the maximum level, which is the reorder level plus EO2. Then we have to less off the minimum anticipated usage in read time. Minimum usage in read time. Then we have safety stock. Safety stock is just average consumption or average usage into, of course, the average is supposed to be the maximum usage time plus the minimum usage divided by 2, even if I don't write it there. Then we multiply by the read time. So you can look at those questions, we see what we can have. Maybe we can add on some trial numbers. These are just for sure formulas, you just plug in values. We have August 2017, question 4. You can also look out for question, I think March 2022, question 2. Even November, there is also November 2019, question 4. Those would be, but you first try out before you go to the marking guide. Don't first look at the marking guide, then you start doing. You will not be learning anything. So I want to start on management of cash. Remember the other items we have done, that ends our inventory management. We want to start on management of cash. Or cash management. How do we manage cash that we've struggled to receive? Now, the concern that we have here for management of cash is that the company should not have all the cash with it, even if it makes sales and converts all its receivables, stroke the debtors, into cash. They shouldn't have all that cash with them. That even if all the debtors have paid and they still hold the money on their accounts, it doesn't make sense. They are supposed to have what we call the optimal cash. Otherwise, the rest of the cash should be invested back, should be plowed back to make sure that it earns more profits. Now, if the company has more cash, the question is, how do we, because it is the same question, it is coming back, how much optimum cash the company must have? And if you are told we can answer this, then it means we've finished how to manage cash. So the only way we are going to answer how much optimum cash the company must have is for us to first balance, between, it calls us for a balance between profitability and liquidity. You see, this word comes back. It comes back and it can actually appear in the question paper. How are you going to be able to balance between, or to trade off between, profitability and liquidity? And you find maybe 6 or 7 marks. So we need to balance off. If at all we need to know, if at all we are to determine the optimum amount, we need to make sure that we balance off between profitability and liquidity, where the company can be able to keep small cash for various reasons while investing the other amount. Even if you have a lot of money, make sure you keep something small, and what you are keeping should be the optimum. Then you invest back, you plow back the rest of the money. As you invest the cash, you will be able to get more cash in form of profits. And if you decide to stay with the whole cash as you earned it, then the company will not be liquid enough. Meaning, if you keep the cash, if you remain the cash with you in your bank account, you have more cash in the bank accounts or even at hand, then it means you are going to be more profitable. Because in your balance sheet, it's going to be showing more cash that you have. But you are not going to be, if you have more cash, sorry about that, if you have more cash, you are going to be liquid. In other words, you have the liquid money. But you are not going to be profitable because you have not made investment. So if you choose to keep the whole cash with you, you are going to be liquid, but you are not going to be profitable. And if you choose to invest some of the cash, then you remain with the optimal cash. Then you are going to be profitable because you will be earning more profits. More cash will be coming in terms of profits from the investments that you've made. But if you don't balance between these two by remaining with the optimal cash, then it means if let's say we've earned the 10 billion, that's the money that we have received from our customers, from all our debtors. They have paid us, and we received maybe 10 billion. And we invest all of it. We remain with the zero. It means we are going to be profitable because we are going to be earning more profits, but we will not be liquid. We will not be having some cash. If we decide that we stay with the whole of this 10 billion, we are going to be liquid, but we are not going to be profitable because we are not earning more cash. That calls for a balance between the liquidity and profitability. And the only way to sort it out is by remaining with the optimal cash. Therefore, the big question is how much can a corporation keep in either in their accounts or at hand as cash. Because even to those commercial banks, because those commercial banks, for them, they use money as their inventory. They use cash as inventory because that's what they deal in. They sell cash. They sell money. So every day they are selling cash through giving out loans. Now, those commercial banks, it doesn't mean that they are going to remain with all the money because some customers are going to be paying back, others are taking. But it doesn't mean that it is going to be balancing automatic, that these people are going, as they bring, the other guys are going to be taking it. You may find one day only people bringing, you don't get people who are taking. So what is going to happen is that you are going to find yourself with a lot of cash. So what they do, they also maintain an ideal cash or the optimal cash. And that ideal cash, that's the cash that they must have, and it is determined day by day, determined by the day-by-day operations of the. For example, if let's say, if you look at Stanbic, it has very many branches. You may find that a branch, let's say Masaka branch, has received more cash because people are depositing more, they are not going to keep that cash. They are going to transfer the cash to the head office, and they will be left with only that cash that is enough to cater for the transaction. That's why even when you go to this ATM machine, you find there is no cash. You'll be like, what happened? Money is there on my account, but the ATM machine has no cash. It happens because they base on the day-to-day operations to forecast the optimum level that they can maintain as cash in those ATM machines. Of course, they may say that on average, people have been withdrawing maybe such and such amounts. So we are not going to put in more. So if they make a wrong estimate, then it means you find yourself not having cash, even when the money is there on your account. But they are programmed it, but that basing on the day-to-day operations. So that's what happens. You need to make sure that you balance and have that optimal amount. So it's even when, because there are times whereby these branches are not going to be having cash. It doesn't mean that every day they are going to be bringing. You reach at a point where you don't have cash, and the cash is supposed to be picked from head office or to the nearby branch. They transfer the cash to your branch because maybe you don't have more that can run the day-to-day operations. In other words, that's why you'll be seeing trucks moving. They are taking cash to different banks because some of them, they may not be having cash, others may be having cash and they're just picking it too. So they pick it when you have a lot, and when you don't have, they bring it back. So that's what they are trying to do, is to actually have an optimum cash at the branch. So that's what happens. So even the manufacturing companies which manufacture and make sales in a day, it will raise a question whether cash received during the day will all remain at their bank accounts. And the answer is no. Hence, we are calling for a balance. Because if they sell, they manufacture and they sell, people bring in more cash. That money is supposed to be withdrawn, not kept there on the account sitting. You have to put it to other use. So the examiner may ask you the reasons for holding cash, holding some cash. Why are we bothered that we should at least have some optimal? Why are we not taking everything that we've earned? Maybe we invest it at once. But we are saying no, it shouldn't be like that. You are supposed to remain with some amount to cater for the day-to-day operations. And there's these reasons for holding cash. Reasons for holding cash. But we have agreed that you don't hold too much. You have to be having the optimal. So some of the reasons are the ones that were advanced by the Chinese, as we discuss them under the inventory management. They are also applicable here. So whenever they ask you for the reasons, you have to start with those ones. Those three, then you add on the other reasons for you to be able to earn good marks. So number one, we talked about the transaction motive. Where cash is required to meet the day-to-day expenses. For example, paying suppliers, transport, and others. Two, we talked about precautionary motive. where cash will be needed to meet unforeseen circumstances, like during the periods of COVID. So, the precautionary motive is all about meeting unforeseen circumstances. And we've seen during periods of COVID-19, companies that never had cash, they suffered. And therefore, cash is kept to meet the unexpected situations. The other is speculative motive. Speculative motive. So, if you expect some deals to happen in the near future, then the company can keep some cash. For example, if you expect things like fall in the price of raw materials, you can keep some cash so that you enjoy the benefit. If you expect maybe the customers may give you discounts, if at all you offset your purchases with cash, then you have to be having some cash to earn those speculative motives. So the other we can talk about, now we are adding in others. We have compensation motive, compensation balances motive. Now, this mainly for banks. For example, when opening up a commercial bank, the Bank of Uganda requires them will give them what we call a minimum balance. A minimum balance or a minimum requirement. A minimum requirement that you are supposed to maintain with the Bank of Uganda. So we've seen some banks collapsed. We've seen Bank of Uganda degraded some banks. Opportunity Bank was degraded. Opportunity Bank, ABC, Capital Bank. Then the other one was GT Bank. We saw in the news, they had degraded them to MDIs. This is tier 2. Tier 2, tier 3. Tier 2. 2, 3. MDI, the micro deposit. The likes of Pride, the likes of Finca. So even these Opportunity Bank were degraded to that extent because of the compensation balances. They wanted them to maintain some balances, but they never met some of the capital requirements that were required by the Bank of Uganda to be deposited or to be left to them so that they can continue running as commercial banks. So when you're opening, even when you're opening accounts, some accounts in some banks, they first request you to deposit a minimum amount. Like if maybe you try to withdraw some cash, you may find that there is a minimum requirement that is supposed to be left there, that you can't withdraw everything to zero. So the reason why they keep that is sometimes they may want to deduct some monthly charges and other stuff. So if at all you had withdrawn everything, they find nothing to deduct. So we want to look at the objectives of good cash management. The objectives of good cash management. The objective is to balance between liquidity. The objective is to balance between liquidity, where there shouldn't be too much cash in the company, and not too much profit. In other words, we are balancing between profitability and liquidity and profitability. So we should, even when we have made more profits, we shouldn't keep all the profits that we've made. We should go and invest. And at the same time, we shouldn't invest all the cash that we have earned. We should invest and remain with some cash. So this is therefore a call for holding sufficient cash to be able to meet, one, the liabilities as they fall due, while making sure that not too much cash is held in the business. So that's the main objective for us to be able to manage, to have a good management of cash. So we need now to know what are some of the principles of cash management. Principles of cash management. Once, as a business, once you have receivables, or debtors, one principle is to accelerate the cash collection. So once you have the receivables, one of the principles is to accelerate the cash collection. And how we accelerate the cash collection, we will discuss it more under the receivable management. But we need to do so that we don't suffer from liquidity issues. So once you have receivables, make sure that you accelerate cash collection. And the reason why we are doing it is because we don't want to suffer from liquidity challenges. We've seen why we need cash in a business. Number two, if the company realizes that it has a problem, then the next principle to manage cash is delaying paying suppliers. These are just tactics, or these are just ways how you can have money in the business. One of the ways we've said, you accelerate cash collection. Cash collection from the company debtors. And number two, once you realize that you have a problem, then the next principle that you can do to manage your cash is to delay paying suppliers. Once you realize that you have a problem with the cash is not enough, then you can delay paying suppliers so that you can avoid you can avoid shortages. Because shortages of cash, they are not good. For example, we saw that during that COVID period, most governments helped companies by deferring their tax obligations so that these companies can have some cash to run the business and pay off some of these day-to-day expenses that will come up, so that they can pay later when at least they have gotten cash. So that would be one of the ways how you can maintain cash. You don't deny paying suppliers, but you restrict. Maybe you negotiate on how you are going to be paying them. The other is maintenance of minimum cash balance. Maintenance of minimum cash balance. So these are mainly applicable in commercial banks, where branches always balance each day the available cash so that they can be able to know how much they have, and if it is in excess, they transfer the excess to their head office. And when it's not enough, then they can arrange with the Treasury Department so that they can be able to get more cash to maintain the optimal amount at the branch. Because you'll be knowing that on average, these 8 people maybe withdraw 10 million every day, maybe on such and days, depending on the location of the ATM machine. So you'll be knowing that at least if I put in this, by tomorrow it will be done. So you maintain the minimum, but not putting it to be there available when no one is actually utilizing it. So the gist of the matter here is actually looking at the cash management modules. That is something that is a bit new and it gives students headache. The cash management modules, they are like techniques that we use, all the methods that we use to manage cash, so that we can have an optimal cash at the branch. So let's look at the cash management module. These are like tools, and here I need you to be a little bit attentive because it has some computations, very small computations, but you need to understand the argument. Now, these modules, they show how we can balance between profitability and liquidity. That's the role of these modules, all these methods. And we made some of these modules. And the popular one is the economic order quantity. Economic order quantity that we used in inventory management. It also comes back here, EOQ. The other like the JIT, just in time, and others. But here, for cash management, we have only two models that we are going to look at, and they are the ones that we use. We have what we call I don't know how to pronounce that, Baul model. Whichever way you are pronouncing it. But this it was named after a person. Baumo is the person who developed. It was developed by a person called Baumol. But as he developed his module, other economists, they came up and developed another model, because their argument was like that this module had some small limitations, and they came up with what we call the Miller-Orr model. So there are two, the Baumol model and the Miller-Orr model. And these are the two methods that we use for management of cash. The Miller, this is one person, then Orr is also another person. There are two people that came up with this model, but these were economists. You know, from the economic perspective, they looked at this and they argued that it had some limitations. That's why they came up with this. But we are not going to say that this one is better than the other. So, but what I want you to understand is that these are the two modules that we are going to have, that we are going to use for managing cash. So, and these are the modules that are going to help us determine the optimal cash requirement. So, these are the ones that are going to help us get the optimal cash requirement. And beyond that level of cash, according to the model, then if you have more than this, because they will give us the optimal, but if you have more than that, then you will have to invest. You will have to invest the excess. But if you invest that excess and you realize that you don't have enough cash, then you liquidate those investments. Meaning the two things that we are going to be moving with, that are going to help us determine the optimal, or that are going to help us have the optimal cash amount, is the role of these modules. They are just going to help us get the optimal cash required. But the decision point will be, if you have more than this optimal, then you have to to invest it. You invest the excess. In other words, we are investing the excess. Now, when you find yourself that you don't have cash, you have now less cash. Maybe you have made your investment, you had more cash and you have invested, and you realize that cash is now slowing down below the optimal. Then, if it is going less than the optimal, then we are going to be required to liquidate or to sell off the investment. Sell off the investments. So by you selling off these investments, are you not seeing that there are chances that we should invest in short-term assets? Because anytime we are going to need cash, we are going to sell off some of them. So there should be at least liquidatable assets that can actually bring in cash. Because it will not make any sense for us to say that today we need money, but we had made a long-term investment of, let's say, 10 billion. But we need cash. Now we say we are going to sell off our 10 billion. You'll take a lot of time to sell off an investment of 10 billion. Meaning, you should make more investments in short-term assets that are sellable. Maybe you are investing in treasury bills that you can easily exchange. Commercial paper, you can easily convert it and get cash when you need it. So there are two mechanisms. When it goes above the optimal, invest it. Invest the excess. But you leave us with the optimal figure. If it goes below, if it is decreasing and it is going below the optimal, sell off the investment to raise more cash. That's how we are going to be balancing between liquidity and profitability. Because profitability is going to be on this option where we are going to be investing. We are investing, we are earning more profits. And when we come to sell off, we are liquidating, we are getting cash, we are becoming liquid. I hope I'm very clear on that. So that's how we should be. For example, if a similar situation, you can look at what happened to NSSF. NSSF, by the time they said that you guys, you should pay those guys who are above 45 years, they are 20% contribution. 20% of their contribution. And you find yourself, you don't actually have cash. What do? You sell off, you liquidate some of the assets to raise the money. Because the contribution was declared, it was supposed to be paid. Whether you delay with the liquidation process of these short-term assets, but people need they need to access their funds. So that's the implication. If you find that cash is not there, because when employees make contributions to NSSF, they don't keep money there. Money is taken maybe to real estate, money is taken to insurance companies. They use the money and they pay them dividends. They pay them interest for the money they borrow. That's why in these days, when this very week, when they were doing their annual general meeting, they were talking of lending to the government. The NSSF, when they were doing their annual general meeting, they were talking about lending to the government. Instead of the government going outside to borrow money, they should borrow from the people's contributions. But the challenge, anyway, it's about them to go through that, but as long as you know the money can actually come back as you need it. So we need now to look at the two models. We are going to start off with the Baumol model. This Baumol model is actually taking the approach. It is taking the inventory approach. It is taking that inventory approach. Now, this Baumol, it was also called the inventory approach because Baumol was actually, the model was modeled based on the economic order quantity. His model was modeled basing on the EOQ, economic order quantity. And that's why they rephrased it to be taking the inventory approach. Baumol noted that cash balances are similar to the inventory levels. And he developed the model basing on the economic order quantity with the following assumptions. So for him, he noted that the cash balances are similar to the inventory levels. And he developed the module basing on the economic order quantity with the following assumptions. So let's now look at the assumptions. Now, the first assumption says that the entity, remember these assumptions are supposed to be given the way they were given by the person who developed the model. They are saying that the entity or the company uses cash at a constant rate. At a constant rate throughout the year. Throughout each year. Even when I'm not an economist, I can see that this actually is wrong. So if you are given the limitations, you can just criticize this because it assumes that the company uses the cash at the constant rate. It's impossible because at some point these companies may actually use more cash or less cash. It keeps on fluctuating. So when you are given the limitations, you criticize. I'm not going to talk about the limitations. That's why I'm explaining. But for you, as you are giving, you just state it the way it was given. The other is the entity replenish its cash immediately. As soon as it runs out of. As soon as it runs out of cash. It runs out of cash. Of course, you also know that this one is impossible because if you had invested the money, it will take some time for you to sell off those assets. It's like saying you get the money when you need it. It's not always true. That's why the economists, they came up with their version. But we are not here to say that this was best, but you analyze it basing on how you have interpreted it. So, as I said, this is not always the case because companies can run out of cash and cannot even afford to have that cash immediately. For example, in the periods of COVID-19, you couldn't get cash. Even when you are to borrow, the risk would be higher, meaning you will be qualifying for less money. The other is cash is replenished. Cash is replenished. Replenished means replaced. Cash is replenished by selling short-term investments. Now you see, this is not the only way how we can actually get cash. You can get cash through borrowing. So it's not always true that cash can be replenished by selling short-term investments, because that's what they are telling us. If you have more, invest. If you don't have, sell off the investments. But remember, these short-term investments earn interest. For example, what NSSF did, raise the cash to pay off the 20% contribution for those who had reached that period. The other is day-to-day needs or day-to-day operations or needs are funded from current account, from the current account. Remember, these are just assumptions. A current account is an account that a company holds, but they don't earn any interest on it. So it's not always true, because other needs can be financed by even loans. So the other is holding cash. Holding cash has a cost. So by holding cash, there is an opportunity cost of not investing the cash. So by you holding money, being the money, and you don't invest it, there are benefits that you are foregoing that you would have received if at all you had done investment with that cash that you are holding. So that's the cost we are talking about, and that's true. So those are some of the assumptions we use here, but we said we use the economic order quantity formula that we used under inventory management, and it's the same formula that we use under the Baumol model, but the definition of the items, they differ. So let's look at the Baumol formula, Baumol model formula. Let me just call it Q. It is 2 OCD times over HC. We use the same formula where, but the items are different. Where, now let's look at the items. Q is the optimal cash we must have. Then OC is the cost of transaction. It is transaction costs. Then HC is cost of holding cash. cost of holding cash. Then D is the demand for cash. Demand for cash over the period. So, therefore, if you go beyond the calculated Q, if you go beyond this calculated Q, the solution there is for you to invest that surplus cash. And if you go below this calculated Q, you sell off the investments. You sell off the investments so that you can replenish the cash. Now, the cost of transaction, the cost of transaction, these definitions, they actually change with that of the economic order quantity, because under inventory, OC was the ordering cost or cost per order. But this side, it is the transaction cost. In other words, the process of investing some money, you incur some costs called transaction costs. Now, the holding cost in this process of the company, these holding costs, in the process of the company staying with the money without investing it, you incur some costs. And that is opportunity cost, because you had invested it. If at all you had invested it, you would have earned some interest or profits. But because you prefer to keep the cash, then there is opportunity cost, and it will be the interest you lost or the interest you will lose as a result of not investing. So the D is the demand for cash over the period. And the D changes from the D we had under inventory management, because what we had, the D we had under inventory management was per annum, but here it's demand for cash over the period, where it could be a period of 1 month, a period of 1 year, a period of 2 years, depending on what they have given you. So the model suggests that when interest rates are high from where you invested, the cash balance in the non-interest bearing accounts should be low, because if the interests are high, then you should invest and earn. Hence, on the current account where you don't earn, you should keep it at zero. In other words, you should keep it low, but not zero. You make sure that there is something, but not necessarily, but almost as if you have zero. So let's do maybe some simulation. That's when we shall be able to understand simulation. KK Limited invests all cash as soon as it's received to earn interest of 5%. 5% full stop. It incurs incurs expenditure of shillings 16 million each year. And pays for this at a constant rate each year, each day, full stop. The cost of converting a bunch of investments into cash is shillings 250 regardless of the size of the transaction. Full stop. We have the required. Use the Baumol model to decide how much cash should be obtained each time investments are sold. So let's look at the solution. We want to know how much cash should we obtain whenever we sell off the investments. Remember, we invest in very many assets. So we keep selling one by one until we raise the optimum amount that we need. In other words, you have done your investments. You need to liquidate them to get some cash. And the question wants us to know how much you could get if you sell off these investments. So we are looking at the Q. We use the same formula for economic order quantity, which is OC times D over HC. So they have told us that HC holding cost is 5%, and this is the opportunity cost. Opportunity cost of us keeping the money. Then OC is 250. It is regardless of the transaction size. Then D is 16 million per year. So we substitute in our formula. So Q will be the 2 times the 250 times the 16 million, 16M over 0.05. So this will give you shillings 400,000. In other words, when you are going to liquidate your investment, the minimum cash or the optimal amount is 400,000. And the moment you get this 400,000, you don't liquidate anymore. In other words, you don't sell more investments until you have gone below this 400,000. Therefore, if you have more than 400,000, then you have to invest that excess in the interest-bearing accounts where you are going to be earning some interest. However, the most examinable area is the total number of transactions. And over here, the overall transaction costs, which is, of course, you have to look at the overall transaction costs. It's going to be obtained by getting, because the total number of transactions is going to be the just like the way we've been looking at annual demand divided by the optimal amount. The other side, we were talking about the annual demand divided by the EOQ. In other words, the number of transactions. The number of transactions. Just like the way we looked at the number of orders, where we got the annual demand, then we divided by the EOQ. So here it will be the periodic demand, because here we said it's not always annual demand, it is per period. Periodic demand over the optimal amounts. So this gives us the number of transactions in the period that can raise the annual or the period demand of the company. In other words, after you getting the figure here, which is the period demand is 16 million, divided by 400,000. So this is giving you 40 transactions. 40 transactions. Just like the way we are trying to look at the overall transaction costs. It's like the holding, the ordering. So the overall transaction costs, are going to be the total number of transactions that we've just gotten up there. Transactions times the cost per transaction. The cost per transaction. So this will be, we've got the total number of transactions, we got 40 transactions. So it will need these 40 transactions times, these are transactions, times the cost per transaction, which was 250. So that will give you shillings 10,000. Finally, we have to compute the opportunity cost of holding cash per annum. In other words, we are looking at the holding cost. The opportunity cost of holding cash per annum. Because we have that annual demand, it will be equaling to the average cash balance times the opportunity cost. Opportunity cost, or what we call the interest rate that they gave us. So this is going to be, this average cash balance is the EOQ divided by 2 times the HC. So the EOQ, we got it as 400 divided by 2 times the 5%. That's the interest they gave us. And you get the answer. So there are some limitations. I said I'm not going to talk about them, but let me just highlight something, just for reminder. Limitations, they can be called criticisms. They can be called drawbacks. Of Baumol model. So we have some limitations for this model, and the rule of the thumb, if we are told to give the limitation, is just to oppose. You have to just oppose the assumptions. And after opposing the assumption, then you can explain why you are opposing. Because remember, for the assumption, we just state them. So you can read through our study pack. We gave those, that we highlighted some of them. So let's look at the other model, the Miller-All model. Say these are two people. Now, the Miller-All model opposes, this one, it opposes the Baumol model, because the Baumol model assumes that cash payments are evenly spread over time and are constant. In other words, they are constant amount each period. And in reality, this is unlikely to happen, because there will always be much more uncertainty over the timing of the cash payment and cash receipts. And it's what actually, it's what is happening practically. Because the timing of the payment and the timing of the receipt, it's unpredictable. So for him to come and say it is constant, you receive, it's a constant amount each period, and it is evenly spread over the period, the cash requirement can't be even for all the periods. So these are the things that they were opposing. Therefore, this Miller-All model is disagreeing with the Baumol. But even though this Miller-All model is disagreeing with the Baumol, it doesn't make it superior. It doesn't make any of these two superior from each other. And most of the times they examine these two. They bring the two of them. So it doesn't matter. We don't want to look at which one is better, but we just need to understand the arguments. So we need to understand both of them and what they are arguing about. Now, under this Baumol, there is recognition. These are the key things. Recognition of uncertainties. That these uncertainties, they can happen. Uncertainties in cash flow. Because the Baumol says this must be constant, but these guys are saying they recognize some uncertainties that you may actually not have a constant cash requirement, as they are saying. Because this is actually what is happening in the practical situation, the reality. There are periods when you need cash, and there are periods when you don't need cash. There are periods when you have it, there are periods when you don't have it. So there is a recognition of those uncertainties. Therefore, the Baumol, the Miller-Orr model has what we call the control limits. They have control limits. So for them, instead of saying it is constant, they just put uncertainties, they recognize them, and they put limits. These limits, they are going to be in a sense that when you have too much cash, what do you need to do with that too much cash? In other words, when you reach the upper limit, when you reach the upper limit, that's when you have a lot of money. And they also have the lower limit. So when you have reached the bottom line, in other words, you have gone below, you have low cash, you don't have cash. So their situation is that what are you going to do if at all you have more cash? Then what are you going to do when you don't have cash, or when you have gone below, or when you are at you are below the limit, you are the lower limit. So if you are at the lower limit, what will you do as an organization? If you are at the upper limit, what are you going to do? Because at the upper limit, you'll be having a lot of money. But in between these two limits, the lower and the upper limits, there is always what they call the reorder level in between the upper limit and the lower limit. There is that reorder level. Now, the Miller-Orr model came up with 3 limits. They came up with the 3 limits. They come up with the upper limit. For example, the upper limit. Two, they came up with the lower limit, and 3, the control limit. This control limit, for them they called it the return point. So the return point could be that ideal. It is where you are controlling everything. This return point is the ideal, or what we call the optimal cache. Is the optimal cache that you must have, this return point or the control. Now let's first illustrate, because they have an illustration for it. We can illustrate it. Here we have cache balances. Here we have time. Now, the first one, they have a dividing line. And this dividing line, the middle line, is the one they call the return point or the control point. Below the return point, there are dotted line that indicate below is the lower limit, and above we have what we call the upper limit. Now this is how they manage it. Because you are not supposed to go below, you start from the turning point. The return point is acting as the minimum. So it keeps on fluctuating. Because we said they recognize, it keeps on fluctuating. So it keeps on changing. So that's how the curve looks like. Now we need to explain something. This lower issue here, the lower limit, or what we call the minimum cache holding limit, this is always decided by the management in the business. It is within the company's policy, and it is decided by the management. And most of the times if, let's say, there are these, let's assume it's a commercial bank. Because this cash management is mainly practiced in commercial banks. Now, in commercial banks, you find that each branch has a minimum cash amount that it must hold or it must have. And if it goes beyond, then they must do what? They must invest And for the branches, for these branches, they may not actually invest, but they will send it to the head office, or they will deposit it in their company accounts that are held in another bank, so that they keep on earning interest. Now, from this diagram, as we sell, we continue to make more money over the different periods. So money keeps on increasing as we keep on selling. Money keeps on increasing as we keep on selling, until a certain point. It can't exceed this point. That is the upper limit. And if it reaches the upper limit, this mirror or model says you have to invest. Now, because it's at the beginning of the year, let's say it is at the beginning of Jan. Let's assume that at the beginning of Jan we had, let's say, 20 million. Let's just use some scenario that at the beginning of Jan we had 20 million, and at the upper limit we have reached, let's say, 100 million. Let's say this is possible in April. This was Jan. Now, mirror or model suggests that we invest the surplus. What will be the surplus? It will be 100 million minus the 20 million. That will give you 80 million. So the 80 million must be invested immediately. When you invest the 80 million, you no longer hold more cash. Because if, let's say, at this point we had 20, this is where we had the 20, and it kept on increasing to 100, we invested. When we invest, it comes down because we are no longer having extra. Meaning it is going to come back to this point, the returning point, this one. It is going to come back to the returning point. But since you have invested all the money and remained with the 20 million, meaning this is the 20 million at the returning point here. This is the 20 million at the returning point. Then the company may return to having less money because you had invested all the difference, the surplus that you had. Then it may start dropping, comes back, keeps on dropping. Now, when it comes below this point, when you have seen it has gone below this point, this return point, then what we can do is we sell off. Due to this recession, we sell off the assets. These assets we had bought, the 80 million that we had used to buy the assets, we sell off. Now when we sell off, we start gaining some cash. It moves. When it moves back, if it goes and it goes, we invest, and it comes back. We invest, it comes back. So that's the kind of movement. So this reduction, what is key is that this reduction, if it reduces, it shouldn't go below this lower limit. it shouldn't exceed this minimum point. So if the company set it, you can find that the minimum amount, the company set it at 10 million. Meaning, if it is to reduce, this 20 million is to reduce, it shouldn't go below 10 million. So by the time it comes back as if it wants to reach 10 million, we sell off the investment, it goes back. It shouldn't go below the lower rate. Therefore, when you reach this lower rate of 10, they advise you sell off. When you sell off, it goes back. Meaning, you sell off the assets you bought in boom. But remember, those assets were earning some interest. At least you earned some interest before you sold off the asset. But when you liquidate, you shouldn't liquidate all the assets. You should only liquidate to that amount that can maintain. You liquidate up to a tune of 20 million. Now, if it had gone this side, meaning it is already below 20 million. But remember, this side it is 10 million. So when it moves, maybe it's around 12 million. You say what is remaining to make the 20 million is only 8 million. So you only liquidate off assets for only 8 million to come up to the other optimum level. That's the implication. So we sell goods because when you liquidate and it goes to 20, it goes back to 20. You are not going to stop selling goods. You are also going to be getting some more money. When you get more money, it shouldn't exceed this period, that upper limit. It should be balancing within those 3 limits. So, for exam purposes, it is better to make this paper practical by you drawing this same graph. Because if you are explaining and you draw the graph, you will explain less as compared to someone who is just writing paragraphs. Even though any approach is right, you can explain what I've been talking about without drawing this diagram, or you can draw the diagram and you explain less. However, there are some calculations that we are supposed to do because we need to determine that optimal amount where there is that return point, this return point here. We are supposed to calculate and see the figures where there is this return point, the upper limit and the lower limit. But we have agreed that the lower limit will always be set by management, depending on the cash needs that we can be buying, or we can sell ours. So it will the lower limit is always given to you in the exam. To be able to understand the calculations, there are some words that you need to first understand. There is always a difference between the lower rate and the upper rate, and the difference is what they call spread. So the cash balance should always fluctuate between the upper and the lower limit. The distance between the lower limit and the return point is 1/3 of the total. Now, I said for you to be able to understand these calculations, there are certain things that there are certain definitions that you need to understand. One, there is what we call spread. Spread, this is the difference between the lower and the upper limit. So that's the difference. Because the reason as to why we are getting the spread is because the cash balances will always fluctuate between the upper and the lower limits. So the spread is like we are looking at how spread is the balance from the return point. Now, the distance between these are key terminologies. The distance between the lower rate, the lower limit and the return point. The return point or the control point is usually a third of the total spread. The spread, we said it is the difference. So that distance is already a third of that difference. The other distance, the distance between the upper limit and the return point is usually 2/3 of the total spread. And the question is, what is spread in terms of computations? So we need to know the formula for computing spread. Spread is always 3 into 3/4 times the transaction costs times variance of cash flow. Variance of cash flow over the interest rate. The whole of this is to power third, 1/3. Then the return point is the lower limit plus a third of spread times spread. And the upper limit the upper limit is the lower limit plus the spread. Maybe to clear this a little bit, the whole of this is 3 by 4 is on this side. So you have to note that the variance and the interest should be expressed in daily terms or in days. And if the question provides you standard deviation of days, in other words, standard deviation of daily cash flows, you need to square that number to be able to obtain the variance. So that's how we compute. But everything, what we have to first do is we are supposed to first compute the spread, because you are seeing in the return point we have a spread, even in the upper limit we have a spread. So you have to first compute the spread before you compute any of the given limits. So that's basically what we can do. Trial number, these are just formulas, you just substitute in the figures. Trial numbers, we have December 2022, question 2. Question 3. Question 3. You can also look at May 2019, question 4. No, this is question 5. Question 5. Then the one of August is the one which is question 4. August 2019, question 4. Then you can also look at May 2017, question 3C, part C. So those are some of the trial numbers that you can see and practice. Now, let's look at just a small matter of management of surplus funds, surplus cash. What are some of the ways how we can be able to manage surplus cash? We all know that surplus cash comes, for us to have surplus cash, it means it is going to arise when a business has cash and it doesn't need it for the day-to-day business operations. So when you identify that you have surplus cash, then you need to plan for how you are going to use that surplus cash that you've got in the business. Because holding cash is wasteful, because cash in a current bank account earns no interest. So if the surplus is likely to be long-term, the surplus should be invested in long-term investment. So we can invest in short-term investments, but if this surplus was supposed to be there, in other words, every time we have excess funds, we can put them in our long-term wealth generating projects. or you can actually buy assets. For example, you can plan for maybe market expansion. But if you find yourself that there are no stable wealth producing assets or projects that are available, then the entity can consider returning the cash as dividend to the shareholders, because you are going to be having cash and you are not going to be using it in the business. At least you better pay off the shareholders. But most of the times the surplus is likely to be temporary, and it would be more appropriate to invest it in the short-term projects or short-term investments. So, but you have to take note as you are investing this money that you need to be careful that it's going to have the liquidity will be there. In other words, even these short-term investments, they should be easily converted into cash when we need it, because surplus cash always going to be a short-term aspect. We can have it maybe for 3 months, but in the other months we find ourselves needing the same cash. The other is the safety. You may be having surplus cash, but don't just make ridiculous investments because you have the cash is available and you have nothing to do with it. You have to make sure that you invest, but you keep accepting the level of risk that will not make you lose more money. In other words, you take calculated risks. Then the other is the profitability. So those are some of the key things that we need to take into consideration as we are making as we are looking at the surplus that we have. But maybe what are some of the ways of investing the cash for short-term periods? Ways of investing cash. Investing cash for a short time. We can maybe put our money in the savings account where we are earning interest. Most banks will allow a business to place surplus cash in their savings account. Number two, it is possible for you to buy some money market investments. We looked at money markets. Of course, you can talk about money market investments. You can talk about the treasury bills. Those are short-term instruments that are going to be easy for you to liquidate when you need money. You can also go in for the bonds that are traded on the bond market, because these bonds they offer higher returns because there is always a greater risk. So the bond prices can fall in the credit rankings of the bond, and you find even the bond itself is falling. So the bond market is not always liquid. So it might also be difficult to sell the bonds for a fair price when cash is needed. So if you look at the bonds, it's better if, let's say, you have that surplus that is consistent. But if you are to make money, or if you are to just put in your cash and you expect to pick it in a short run, bonds are not issues that you can invest in. Then the other, equity investing. You can also become a shareholder with the cash that you have. So some of these, they are long-term in nature, but I'm just giving you the general aspects that you can do. So we can also look at maybe what are some of the short-term sources that can be available. We have the short-term, we talked about the bank overdraft, because you may find when you need money, instead of you being in a surplus and you are in a deficit. If you have a deficit, at least you go in for bank overdraft, you go in for short-term bank loans, or even debt factoring. We shall talk about debt factoring later when we are handling the issue to do with management of receivables. But those are some of the things that I wanted us to share as far as these two working capital management is concerned, basically for management of cash and inventory management. So we have finished those two. What is left is receivable management. I said receivable management is supposed to be handled separately because it has very many issues that we need to look at. It's very wide, we can't just mix it in here because it has things to do with settlement of discounts. There are very many stuffs. Settlement of discounts. There are issues to do with invoice factoring and discounting. There are issues to do with credit policy, debt collection techniques. In other words, debt collection. So there are very many aspects that we need to handle. So when we look at even the credit policy, so there are very many key items that we need to look at. So that's all that we wanted to cover for now. Let's wait maybe in the next video because this is going to be ending here, and we shall handle the receivable management in the next video lecture. But so far we've moved a little bit far. The key issues that we need to look at as per the new syllabus, we have issues to do with Islamic finance. We have issues to do with business valuation. We have issues to do with the financial distress, then corporate restructuring, and we can also talk about the financial distress. Then we skipped the risk and returns, but this is a very small topic. So plus what we haven't covered, the receivable management, and also maybe international trade. There are also things to do with mergers, but they are within this corporate restructuring. So they are key things. I'm handling them according to the degree of how I think, how important I think. This is a new area of Islamic finance. It's a new area in Uganda. We've seen some banks have started coming up, like Salam Bank. I've seen it has started distributing its branches. So it is a good area for you to be able to understand, and it's a must to appear. Business valuation is something new but very easy. Corporate restructuring, then maybe international markets. So if we handle these four, then we can maybe start off with our revision. Then we see how we can fix in this and this. But this is a bit wide, but these ones can be combined at once. Even this can be combined with this. So those are the key issues that I'm left with as far as financial management paper is concerned, even adding some computational numbers, but we are going to do more numbers in revision because that's where I plan to have a lot of numbers on all these aspects. We pick out those that we see are going to be a little bit of a challenge or that has something new to learn, because there are numbers that you are going to see, but you're doing same numbers with the same way we've been doing it. So we pick out numbers that are going to have something new for us to be able to learn. So that's it for now. Thank you for watching. Endeavor to subscribe, share to your colleagues so that they can also have the same benefit that we plan that maybe you have received. But that's all for now. Thank you for watching.